grandmother, and this is now a bit closer to our age. I don't know when you were born, but I assume that most of you will be able to locate yourself on this chart somehow. We all have been already growing up with some banking innovations, but what was striking to me that indeed computers and banking were together already in the 60s, that the first mobile banking has been around since 97. And when I show the Czech Republic, for example, you will see that for obvious reasons, like in many of your countries, there was not much innovation before '89, but afterwards we tried to accelerate and catch up. So at least for Czech Republic, the internet banking first around was in '98 and mobile only since 2011. So with that, I will start moving us to the trends and innovations which most of our banks are looking at, but I would not talk about particular innovations, but rather the trends. Many of them you will recognize, and let me start with this simple overview. Don't worry, we try to keep the time, so I will not be going through all of them, but try to highlight what I find the most important ones, which are currently shaping the future of banking. To start with, identity. Digital identity is not only something we as consumers are encountering every day in our life, but as banks, we have multiple opportunities how and what role we want to play with regard to clients' e-identities. It's difficult because I know you're coming from different countries to set the right starting position, because there are really big differences between digitalization in the individual, even Central European states. But us here in Czech Republic have stepped into the ecosystem between the Czech Republic, the governmental offices and banking sector very successfully, not more than, I believe, 2-3 years ago, when we have introduced the Bank ID. With that, we helped very much to digitalize the Czech economy, but the usage of the Bank ID, of the identities which banks issue in the electronic form is expanded in between from the state usage also to commercial usage. The important thing here is that clients trust us with their data, with their, not just cash, but with their data, obviously. And the next role which we see is the role of the custodians of whatever data the customers would be willing to entrust with us, and whatever information or content, generally speaking, we would be able to share on their behalf. The next trend, which I will talk very briefly about and highlight, is digital assistance. I don't know, again, what your starting position is in your banks, but most of us have been embarking on the chatbots journeys for the past few years. My bank in particular has been in that business for certainly more than 5 or 6 years. Under the digital assistant topic here, I see actually much more than just the chatbots. We ourselves have already embarked on the true virtual digital assistants, which is also voice operated, which is fully integrated in the backends, and are able to provide a full assistant end-to-end on more than currently our processes, 150 processes and end-to-end situations. But it does not stop there. Our idea is to have real full-fledged assistant, and we know we are not the only ones. Sooner or later, other banks will be joining us as well, and it is already developing also on the Czech market with different level of maturity, once you go in that topic, and no matter how far you are in your banks, you will see how huge difference it is between operating a chatbot, which is usually not personalized, not integrated, and a real assistant, which actually replaces the human interaction. On the next one, the next trend, most of us, again, will be racking their brains on and about, is the distribution model. Most of us are, of course, having clear strategies where we want to go. But this is, again, a very difficult topic. How do you actually juggle in parallel the digital bank and the more traditional bank? Often the digitalization is assumed to replace the physical distribution networks. But again, as most of you will know, this is typically not the case. So the big science here and the magic is how can you keep your costs under control while operating in parallel in multiple distributions and many more environments than we were ever used to. It's very much linked also to the next trend and next topic, which I call the work of the future, because of course also your workforce in the banks is changing more and more. We are looking at different skills. We are looking at how to combine the data topics, the AI attached to it, together with simply physical and people with skills, I would say not of the past. Of course, they are still needed, but it's not so easy to make the switch in our companies so easily and have actually the right skill set and mindset in the right direction when all these things around us are changing. The next two trends are in a way connected. Banking as a service would be another topic worth in our talk. But again, no matter what you do, you must have been thinking about how not to stay closed in your own environment, but how can you be a valid member of any other ecosystem. So that is why I'm saying, depending on which view you take, either you as a provider are able to step into an ecosystem like the mobility ecosystem, energy ecosystem, real estate ecosystem, with the danger that your bank becomes invisible, but at the same time it's a huge opportunity for diversification of your portfolio. To be quite honest, we will be becoming invisible. For most of us, this is actually the future, because the products and services which we provide will be embedded in people's everyday lives and everyday needs. So it's just up to us, up to you, up to our companies to grasp the opportunities, and the technology these days actually allows us to be in many more places as a bank than we were ever able to be before. Metaverse, sustainability. Here again, a bit of interaction. Anyone thinking about metaverse in your companies? Like raise hand or make a noise or... No? Well, yes, some are looking into it. I must say us not actively, as I was trying to say that we are super active in the AI data, full integration and assistance. We are not yet in the metaverse mindset, but this was also nice feedback getting from you. At the same time, the fact that we don't do this now, it's not to say that this is around us and it is to come. So we will see how long, and time will show how long it will take between now and then. Já se pohybuju a přestávám vždycky mluvit, že? I will try not to move so much because I hear myself there must be some interruption, so I will try to, the gentleman over there is trying to be nice to me, direct me. I will try not to move. It will make it hopefully better for you as well. So the metaverse is not a big topic. I will stop here then, but with the new generations coming up, will this be better? Yeah, I guess I'm a big mover or something, I don't know. Normally these work, or it's my hair. Anyways, this will be safer. Now I feel super wired. Let's continue. Sustainability, obviously, a huge burden for most of our banks. When you think about already the environmental topics, which are clear, now with the social, the ESG, the S taxonomy coming up on the European level, there will be another 130 pages document which we will all have to adhere to as companies, and will have to basically request our customers to be adhering to with the time as well. So what do you do when you have such huge burden? Of course, you turn it into opportunities. So I will not talk more about sustainability here either, but that's another thing which creates a new banking environment, and it's only about the way you tackle it to make it not only happen, but make it hopefully, not necessarily into new business, but in general into new opportunity, how you can transform yourself as a company. Now, these are not necessarily trends, but when I take the two main products or services banking has ever been providing, the payments and the lending area, there are two things which I like to highlight. Again, even here, I think only the future will tell how big and successful what I call here a trend will be. But on both parts of the slide, there is one thing in common. Often the loan products and the payment products are blending even more than ever. The example here is the buy now, pay later. Is this now a way to take a loan? Is this now a way to pay? Doesn't matter. The customer doesn't care, because it's all about the customer experience. It's about the frictionless experience which we are trying to provide. You can take many more examples of the frictionless approach, and when you look both at payments, both at lending, I mentioned the embedded financing. On the payments, you can think about how fast we have all adapted to contactless payments, to mobile payments, to wearable technology, and so on. So these blended together all result in super smooth customer experience, which these days technologies allow us. I'm coming to the end. There are two last slides and one more video for you. So This hamster, actually, I believe there is a next video, you can look him up. He's got pages, he's dead by now, I think. These don't live too long. But he actually became quite successful and his performance is not worse than the overall market. So, of course, you have seen in other areas similar animals who are quite successful, just like humans. But if you have a hamster at home or not, consider giving it a try. It seems to be a good business model normally. Last 2 points on the trends, it's the crypto assets and programmable money. As much as, again, and here I make maybe a bold assumption, none of your banks will be jumping on the crypto opportunities and encouraging the customers to do the Bitcoin, Ethereum, and all the type of dogs coins. I see a big move in most of reputable banks in the thinking about how can we use the technology, the blockchain, into the new business models. So for us in particular, we are looking into the programmable money. In Belgium, we have actually already launched the first pilots. We have the infrastructure. We will be looking at the use cases also in other countries, but the programmability of the money is what interests us as a bank and as a banking group for multiple uses. I promised last 2 slides, but these are actually the last 2 slides, not much text. This all comes with huge responsibility towards our customers. The more we digitalize, the more we go online, we all are subject to increased security threats, not only us as institutions, but especially our clients directly. I don't think, again, most of us are these days subject to so much real physical bank robberies like in the old good times, but the digital anonymous world increases the pressure here enormously. And last but not least, the innovation in any rapidly or slowly shifting environment is always about people. So with that, I wish you that you're lucky enough and your institutions have just the best people to try to assess the trends as much as and as good as possible because no one knows.
Thank you, Michaela. You covered a lot of ground there. I think I'm fine with moving as well. So maybe just, so first a question. Do we have questions from the audience? Would somebody like to ask a question using the mic here? Seems not so. So we do have one Slido question. So there is, you mentioned metaverse. So question is, how do you perceive the impact of Web3 on banking?
Well, am I speaking to this one? Well, as I said, there is an impact. It's Web3, it's a technology. It will be up to us how we use it. We see, and we are already now trying to investigate. And again, it's difficult to say, I say we, as the KBC group. But I don't want to brag here that we are the only ones. I'm sure all of you are looking into it and how far or close future any technology, Web3, blockchain, Meta is to us, and how fast the client demand and the adoption will be is, in my opinion, unclear. But we always try to look not where the ball is, but where it will be. And that is why we understand that we must start experimenting now if we want to be making use of any of the technology 5 years from now. These things simply will not happen, at least not in traditional institutions at mine, with huge responsibility for huge client portfolios, with huge number of legacy systems. These are not things you can do from 1 month to another once the opportunity has actually materialized. So the Web3 is a topic. It was on my list. That is why it is a topic. And it's now a matter of the pace, which I cannot estimate how fast that will go.
Perfect, thank you. And then one more question from me. You mentioned banks becoming invisible. Mm-hmm. How big of danger is this? And do you see some strategies for banks to become less invisible?
Well, actually, I think really, even as a client, and you as clients, I don't need a bank. I mean, Gates said this already somewhere in '93, right? No one needs the bank. Everyone needs the banking. So in that sense, the bank is not there to be on the high street, and it is not usually there anymore anyways. and we know that our customers are typically not going to come to one website of that particular bank, even when you think digital. I see the biggest success in embedding the banks in every single action of a particular person during the day. This is how you basically will be distributing in the future. Of course, that is, and I'm talking now retail, but even for the SMEs, SMEs are typically even more digital savvy than the regular retail customers. Maybe less obvious for the corporate and for huge transactions, syndicated loan, project finance. There the digital technology will be helpful. There we will not disappear. But the added value of the bank and of the bankers will be clearly somewhere totally else than the customer actually almost begging us to make time when the customer has time. So that is why the embedded bank is, in my opinion, much more logically successful bank, because you're simply there when the client needs you.
Perfect. Thank you, Mihaela.
Thank you.
I'm about to announce next speaker, which will be myself. So hopefully this, and thankfully moving works with this mic. So if we could show my slides, perfect. So my topic is legacy system transformation from reactive cost center to proactive value generator. And I think it is a big topic, a very structural topic in banking. I mentioned before about Slido, so I would highly appreciate if all of you could really go to Slido poll and vote, because this is also part of somehow presentation, trying a bit to compare the situation in this room, which I guess reflects situation in CEE region quite well with the situation in global banking. So there is, sorry, I should get a clicker. So there is a poll here. How would you describe banking payment system used by your institution? Pick one. So 3 options: early legacy, everything before 2000, modern legacy, 2000 to 2012, and then also the modern, the digital native systems, everything after 2012. So again, if everybody could take a minute, this would be great, just to give us a more robust assessment of where this room and with this the region sits in terms of systems. So I see people with their phones, so I'm going to be... Okay, I think this is, let's say, we can check it once again, but pretty much modern legacy, 60-something%, the dominant thing. So I think let's go back to the slides. We can switch back later. What is a legacy system? We talk about legacy systems here. So I would say legacy systems, in simple terms, will be pretty much everything before 2012. I'm taking this classification from IDC. So this is like a simple one, 3 levels: early legacy, modern legacy, digital native. So starting with mainframes, going into API, open era, no configuration, a lot of configuration. You all know the history, so either I think all institutions can be put at one of these 3 levels. Question is this a problem in any way? This is like, we saw our poll results, and this is like a global numbers by IDC. So IDC is pretty much saying 3/4 of all core systems in banks in the world would fall under legacy category, and sort of a bit more than 1/4 would be digital native, fresh, new, modern systems able to deal with today's world. From what we see from the poll, CEE seems to be reflecting this global standard as well. So other than modern is always better than traditional in some gut feeling, why is this a problem? We live in a changing world. There is a lot of competition for banks, a lot of competition coming from new players who started their life maybe after 2012. So by definition, they started with a new, fresh system without a lot of legacy issues. So having a legacy system impacts badly on your revenue potential, because there is simply not all customer needs can be met, not all partners can be integrated with, all these type of things. It impacts badly on the cost, because typically this is siloed, all technology difficult, and also on the risk, because people having COBOL systems, find it very difficult to find developers, and this risk is getting higher day by day. Well, what are the advantages of having a next-gen backend system in a bank? So here, a few points. First point, distribution. Michaela was also talking about embedded finance. So having a next-gen system opens up a lot of potential for revenue growth. Embedded finance being maybe the biggest one these days, enabling geographic expansion, multi-everything system, synergies between retail, corporate banking, all these good things which can translate into revenue growth. Innovation, both in-house, having a configurable system which can be easily evolved, also in partnership, so having a system which can integrate really well with third parties, with product partners, a big plus. Cloud, again, being able to, for a start, put your software in the cloud and run it there with all the benefits of cloud technology, with scalability, with cost efficiency, and also with integration with third parties. Customer centricity, a big thing. So again, many banks historically have product silos and frequently dozens of core banking systems. In this space, apart from lacking cost efficiency, there is a big issue about serving customers consistently, which leads to customer frustration, which again makes banks weaker in the market. Payments convergence is one big topic on the payment side. We'll talk a bit about this, but in essence also many banks, or all banks pretty much have fully separate systems for cards and payments, which historically were very different things. But now with instant payments, with all the new use cases around account-to-account payments, they are becoming very similar, and there is a lot of potential for structural cost efficiency there. And then new products also already, we heard many of these things, buy now, pay later, loyalty, decoupled debit. All of these can also be designed to work on a customer level rather than on a product level. So thinking about financing, ideally this should also work with account-to-account transactions, not only with card transactions. So there's a lot of potential from the backend system side to help banks grow revenue and reduce costs significantly. In a way, also reduce risk by having a modern system. I would like to give two examples of how systems can, how modern systems can help banks. One would be embedded finance, and second one, payments convergence. So first, embedded finance, starting with zillion definitions out there. I'm starting with a simple and broad one. So banking-like services offered by non-banks. And this is already, I think, the gist of it. Pretty much most of times, embedded finance is about combining two customer journeys into one. Whatever is the original customer journey. Is it buying something? Is it like a business getting, I don't know, accounting service from some software? Frequently then separately from that, a payment journey need to start. Combining those two into one helps everybody. For the customer, it is easier because the financial service gets offered on the point of need. For the third party, for the distributor, again easier because for them there is a risk if the customer needs to leave their customer journey to sort out their financial needs, they may never come back. So for them, this is a great benefit, having this seamless customer experience. It has very positive impact on their core business. For banks, it is great because it opens up a new distribution channel. So if done properly, can significantly increase growth, increase customer acquisition, also ideally at a lower cost point. Because you all know it is very difficult to gain new customers through traditional methods. With embedded finance, this can be made a lot faster. Caveat, if you gain your customer in a branch, this is your customer fully. If you gain your customer through embedded finance channel, you are somehow sharing it with the third party who had original access to the customer. Embedded finance cuts across all areas of banking, I would say. Probably most use cases, most famous use cases these days around lending, buy now, pay later, similar, but really payments, card issuing, everything already there are use cases and more every day. In terms of growth, everybody predicts huge growth. I like this way of showing it, looking at 2030 at the overall revenue pool in retail banking. Expectation is that 15% of this should be tied to embedded finance, which I think is a huge number if you think like the current retail banking revenue pool, and somehow almost from 0 to 15% for embedded finance shows how significant this trend is. Because just as an example, in the same research, neobanks come to like 5% of the revenue pool in 2030. So we have had neobanks for a while now. All the banks highly sensitive about the threat from neobanks. But then just few years down from now, the overall embedded finance revenue potential is 3 times higher than neobank, challenger bank revenue potential. Embedded finance stack, this is a bit showing here a few Lego cubes necessary to provide service to a customer, and also to show a bit what is necessary to provide embedded finance, and also what are possible strategies for banks. All of this starts, I'm going bottom up, so somebody needs to have a banking license in order to provide, or some type of license in order to provide services. For lending services, there needs to be a balance sheet in the background based on which you can provide lending. Then things become more technical. So the general ledger, product factory, we single out here partner management, APIs, and then at the end, customer experience. In essence, there are, I think, 3 roles here. One is the licensed balance sheet provider. This is definitely a role. I think on the top, the customer experience, you can call this the distributor. This is the third party who has the primary customer journey and contact to the customer. In between, it's sort of a, you can say, a tech provision layer. Maybe just to unbundle this a bit, we at Vestigo believe that partner management is an independent layer and somehow back office to this embedded finance. Because in order to do embedded finance at scale, bank needs to be able to address a number of strong distribution partners across various industries with various preferences for operating models. So the better the bank can do this, the higher the chance it will be successful with a number of partners. And then imagine, like we said, like total revenue potential, 50% of the total market. Banks who do it really well could, double their market share within years, versus banks who do not do it well, which would be at risk of losing market share. So it is a very sensitive game, which needs to be played at scale. And I'm just thinking, so example, like a case study. one project we did for a client. So here, going like to the layers before. So one is the product factory thing. So again, our view would be that products ideally need to sit on one platform, because this enables then the relationship with the distributor to become bigger. Because because most of distributors would prefer to have a single partner across financial products. Once they do the integration, once they have a trusted relationship with the partner, they can maybe start with card issuing, expand into payments, expand into lending. But it is, for most organizations, a lot more seamless than having multiple partners. So this way, you establish a relationship, you start making a few euro per year with a customer on some product. Over time, you can start making significant revenue per year with this single customer. So again, having this core product engine with multiple products we see as very important. And second thing, this partner management tool, also very important. This is with us designed as really like a partner management system in a way. So onboarding of the partner with all the characteristics sort of done in a user interface in a very easy way. And then also management of the relationship. So in this one specific case study, we had a client who was highly specialized in B2B2C business. They had thousands of products in their system, because for each partner, each product specific was at the end set up as a new product in their system. So the way we've done it here is like just a few core products, and then all the specifics get managed in this partner management system. So sort of you have few core products, and then you can have thousands of core products from market perspective, which leads to a very efficient system which can be run at scale. So much about that. Payments convergence, also a big trend. We see it maybe a bit more on the cost efficiency side and customer experience side, maybe rather than revenue. Quick, Michaela was giving history, so I also need to do a bit of history. This is a bit cards and payments. Historically, everybody remembers cards were one thing, payments were a different thing. So if you needed to transfer money to somebody, you would go to a bank, fill in some form. This would take 2 days. They would get their money. Maybe it would take 7 days if they were in some international destination. Cards were immediate. Cards were global. Cards were in shop. Banks had like one system for cards, one system for payments. This was great. Then things started changing. Technology advanced. There was instant payment. There was all the open banking regulation. Everybody has a brilliant computer in their pocket called mobile phone. So you can do a lot more stuff. In terms of front end, use cases really advanced. So you could generate some type of a QR code, do payments on the account-to-account rails. Everything was great. So pretty much you could start doing the same thing with account-to-account payments like you were doing with cards. Customers didn't really notice, they liked it, but the banks still had the same old system in the background, which treats these completely separately. What happens is, customer has a mobile app, they decide to fund through card or through account. For the customer, this is the same thing, they present their QR code, but because it hits different system in the bank, depending on what they decided, almost not being aware of the consequences, they will get loyalty or not get loyalty, they will be offered installments or not offered installments. So customer experience heavily influenced by the fragmented back office. So what we see as a target model, like these back office systems which were down, need to go up, somehow really catch up with the regulation, catch up with front-end systems, catch up with market infrastructures. So we see as a target model what we call next-gen, bank using ideally a single system across cards and account-to-account payments. And this opens great improvements in customer experience. As I described, you can then, regardless of what you do, you can have the same customer experience. Obviously, deeper customer insights, because everything flows somehow through one channel. And big improvements in operational efficiency, because not only you have one system instead of two, or in many banks, but also you can have harmonized process, which brings big savings. You can have harmonized relationships to third parties. So you can have like single fraud system across all, better unit cost, better, it just works better with a harmonized system. So, and then we see this is a big embedded finance. I think we see primarily as a revenue side plus. Payments convergence we see primarily as costs and process efficiency side plus, and also customer experience. Okay, obviously, I'm just going to make it quicker in the interest of time, but you can obviously rip and replace, so somehow install a completely new system to achieve this. I think for most of institutions with some history existing systems, gradual progressive transformation is the answer because of risk. And then a few sentences about our company. We are PayTech across cards and payments. Currently, we serve clients across industry in 7 markets. Our solution is very modular. We do, for some clients, cards only, for some clients, accounts only. But I would say our big 2 strategic teams are the ones I mentioned. So we have a very strong capability for embedded finance partnerships, for helping banks run them at scale. And we have a very strong solution for payments convergence, for enabling progressive transformation towards convergence across cards and payments. And maybe just going back here, something comes to mind I wanted to mention here. Here, obviously, any strategy is open to a bank. Bank could decide, let's forget about embedded finance at all. Or bank could decide, okay, I'm going to provide license to somebody, and then this organization can sort out everything else and do it. I would say our view is that banks should actually attempt to completely, as much as possible, occupy the space below distribution. So both license, balance sheet, and tech, because we believe like long-term, this gives them the best structural advantage in the market where embedded finance becomes so important. Otherwise, that we believe there is a risk if some other party is completely in control of the solution and the relationship with the distributor, banks becomes very commoditized and in a way very easy then for the tech provider to exchange it for a different bank which offers 1 bp better conditions. But so much from me, and are there any questions first from the audience, not to leave the mics unused? Seems not. Slide-wise, what do you see future the embedded banking in tourism sector? Embedded finance in tourism sector. What happens in tourism sector? Let's say maybe just the tourism doesn't come to mind. Maybe one example now, just to leave also retail banking for a sec. But let's say business software, like accounting software, a great place for embedded finance. Because banks, are sorting out their bookings, their invoices. Payments need to be made. It can flow straight from the accounting software. In that sense, a small business could make a deal with the provider of the business software, and there could be a banking partner in the background. So in that sense, this software will be the distributor, probably partly the tech, some level of integration with the bank. And then from that, all payments could be initiated, but also somehow straightforward lending could be managed. Cards could be issued. If you add a new employee, you just click a button, this employee gets provided with a card. So it opens up many possibilities for integration into business. So I think one thing is integration into customer experience, more on the retail side. I guess on the business side, this is more about integration into business processes of businesses. And then banks, I think, raises the game because they also need to understand the business processes of their customers a bit better than they maybe do today. Peter is showing this sign, which I believe means we are done. So thank you. So next, we have a panel discussion on the topic, is innovation only about technology? And then, so sorry if I look Slido obsessed, I actually never used it up to today, but if you don't mind, again, doing your scan and looking into Slido, there is another poll which we will be using as a starting point for the panel discussion. So it will be great to see where audience stands on this issue. You can see like what is the key element for success with innovation. So it would be great to hear your views. You can have multiple responses, I think up to 3. So either exactly scan it here, type the code, or scan it in the brochure. And while you guys do this, I would start announcing our panelists. So we have Peter Toman from Moneta Money Bank. Peter, if you would please join us. Peter is a Chief Risk Officer and Vice Chairman of the Board of Directors at Moneta. He has been active in banking since 2011 and has worked for Moneta Money Bank, which is previously GE Money Bank, on numerous positions within the risk management division, both in expert and managerial roles. Peter is currently in charge of the collections department, property valuation and portfolio management department of the Moneta Group, and also serves as Chief Risk Officer of Moneta Stavebni Sporitelna. Welcome, Peter. So next we have Mantvidas Štareika. Mantvidas is CEO and board member of the SME Bank, a neobank for business leveraging a single digital platform for the financing daily banking needs of SMEs. Mantvidas is an experienced banking executive with more than 15 years in financial services, leading international teams, guiding company mergers, and launching new products. He is considered an expert in B2B banking, fintech, and startup business development. As CEO at SME Bank, Mantvidas is responsible for strategy, people development, company performance, and growth. Welcome, Mantvidas. And we have Giuseppe Castelbuono. Giuseppe is a senior digital and ICT executive with extensive experience in the banking industry, both domestic and international, especially in Central and Eastern Europe. Giuseppe is currently head of digital and information office of UniCredit Bank in Romania. His main focus is a strong contribution to the digitalization roadmap of the bank, as well as ensuring resilience and reliability of all technology solutions implemented. Welcome, Giuseppe. And Michaela Bauer, who was introduced already and gave us a great presentation, will be joining us as well. So, dear panelists, welcome to the stage. So we have a topic about innovation, and is it only about technology? We asked our audience and offered some suggestions about what might be the secret juice of innovation. And these responses were like, I would say, roughly 50-50 between tech and soft factors. So it would be great to see responses. And I'm just looking at this. So willingness to experiment seems to be very important to everybody. People believe this is a big success factor, followed by tolerance for failure, business leadership, innovation partnerships, collaboration, and then only then keeping up with the tech, modern backend, and other tech factors. So our audience seems to believe that tech is not the secret juice of innovation, but more soft factors, in particular, willingness to experiment. Giuseppe, would you care to comment on that?
Perfect. Thank you very much, and hello, everybody. I will try to say that, yes, I do agree, meaning that the willingness to experiment is a key factor when basically you start a new journey. Obviously, technology should support. So because in general, you need to have some idea what to experiment, some business cases, but also nowadays, the most important, from my point of view at least, is the customer experience. So the true innovation goes through improving a customer experience. So at the end of the day, we see in our daily life a lot of new services that are not dramatically new. For example, Uber, just a simple showcase, no, it's public transportation way, but the possibility to use it very easily in different cities, in different countries, make the difference towards normal taxi driver, for example, service. So then I do believe, yes, the willingness to experiment together with the technology well used.
Thank you. Mantvidas, how would you see this? Are you surprised by the results?
No, actually not surprised. I think that it's a clear answer. So I would like to start with, firstly, to say what's the innovation for me. So I take innovations as, something new, something experimental, not something what was used before, and of course, I think to test, to solve some problems. So it can be a process, changing some processes to make it simple, to make it more faster. It can be a new business model. It can be a new way how to connect with the partner. So it can be different models. So technology, as it is, it's nothing like an integral part of innovation. So it's only one part of innovation. So if we take, for example, a good example of health, so healthy food, healthy lifestyle is also a part of the health of a human. So that's the same with the technology. Looking at the examples, as Giuseppe said, for me, for example, the good innovators from the market is, for example, IKEA or for example, Starbucks, which they are not related to technology. I mean, Starbucks is a good innovator on the user experience side. So they are winning their customers because they can make new user experiences which is adapted to the current market situations. And the same with the IKEA, they are not technology company, but they are good innovators because they can adapt to the customers, by putting a possibility for a customer to buy their, home furnitures in the way as you make a puzzle. So you make a puzzle with your home, using IKEA. So that's a good example saying that technology is very important, but only a part of the innovation.
Perfect, thank you. And then Giuseppe mentioned Uber, you're mentioning Starbucks and IKEA. Peter, is there a reason we are not coming up with bank names when we talk about innovation?
Well, thank you and welcome everyone, first of all. And I think that if I'm looking at the pool, if I will go to that and the willingness to experiment as a main topic which people want to discuss, I think that it's not a surprise, especially in the banking, because banking used to be a very traditional way of industry. And a lot of people still perceive banking as an institution where they can go, they can visit, they can talk, they can have coffee and chat. So to transfer the mindset of people to digital, to actually do something which is a bit unusual and unorthodox is a long way. And I think that especially in the Central Europe, we already went quite far away. And one example which, for me is always very important, and I'm looking at it, especially here in Czech Republic, is the mortgage market, for example. Because, mortgage is a traditional product, and a lot of people actually takes mortgage once, twice per year. And I think that, it's going to be tough to actually, as the management or as the people who are trying to innovate, to convince the people that, for example, go digital in mortgage will help them to do the processes better, faster, and cheaper. So I think that, if we will not experiment and we will not try to channel or actually challenge this traditional way of how the mortgage is perceived, we will be never able to succeed. However, on the other side, we need to be honest ourselves that if we will do such experiment, we might lose market, for example, for a while before all the other competitors will be able to adapt and will be willing to work in an online world as well. So that's how I view it and how I perceive that experiment which we are talking about.
Thank you. And Michaela, people like bankers seem to be eager to be allowed to experiment. How do you see, like, is this a cultural issue with the industry? Do you feel, so obviously there seems to be a desire, but people feel some barrier.
There is a desire, but most of our systems, for exactly the reasons which were mentioned, we have huge responsibility. So logically, the people who are attracted by banking are not the most free spirits, are usually not the most creative, artistic ones of us. So it's also the industry, and it's not so natural to us. But what I wanted to say is, of course, we are willing to experiment, but the discipline and again the responsibility which comes with the experiments is somewhat different than you may afford yourself in some other industries. I'm still not talking. I still believe the experimental stuff in healthcare, but also technology is advancing hugely, is even bigger, because we are in the end doing just money. I still have bigger respect for the healthcare innovation. But the whole system in banking is set up in such a way to actually repel and kill any innovation. I will explain, and I'm glad there is a CRO sitting with us. I also had the pleasure to play the role of CRO. I still consider myself a much better place as innovation person than CRO person. But we also have to look at how many experiments you do. The usual expectation, and you can not or not how your institutions work, there is the expectation that you carefully choose out of 20 opportunities one, but then it must work. I mean, you're obliged to make it work unless, something not bad happens to you, maybe you don't get fired, but it will be considered a failure, which is, by the way, one of the next topics here. We simply do not have the startup idea. We do not have the venture capitalist view, usually. I'm generalizing. And that is a portfolio. You have to try 20 things to make one happen. And that's, for me, the problem. It's not the willingness to experiment, but usually it's money-driven, risk-driven, or whatever driven. You simply choose 1, 2, 3 topics, and you put so much effort into them that you are not already allowed to fail. And that's the problem. We should actually experiment and understand that out of 20, maybe one thing will work. And this is what the people and other industries, I think, are better at than banking. We simply do not do real innovations. We go for the rather sure things, and that's what limits us.
Thank you. And as you mentioned, the next point from the audience perspective is tolerance for failure. So one bank I know had, I think they called it the moonshot program, which was employees should come up with an idea. If this idea passed some committee, they would be somehow granted 1-2 years, I think, on full salary to try to develop this idea in a startup. And then if the startup was successful, bank would keep a certain percentage of ownership and they would remain entrepreneurs. If the startup was not successful, they would be welcomed back to the bank. Supposedly no questions asked, everybody happy they tried. Peter, is this for you like a good model? Do you, like in your bank or in some other bank, like do you know some models which enable bank employees to a bit experiment and not fear of failure and on all these things which are coming out on top of the list?
I think that working with startups is the best way which you can somehow use in banking, because the bank, and again, it's a regulated industry. You need to be very focused on what you can and what you cannot afford. And in startups, in the fintechs, you can be more speed up. You can do actually more investigations all over the market. You can go and fail over and over again. And once the product works, you can deliver. But also, as Michael mentioned, in banking, you need to choose the one which is gonna work. So if you are a banking employee, then you simply need to make it right. Otherwise, the shareholders will not like it, and you will be not able to pay the dividend, etc. But if you are a startup with a small share of a bank, or just a cooperation model, you really can try, fail, and once it works, you can then sell it, and you can then embed it into the banking. So for me, the model as you described it, working with the fintechs, this is probably the best way for the future innovations in such a slow, innovative industry as banking.
I think also historically, I believe many large institutions, including banks, when they would acquire a small company, they would try to integrate it as fast as possible. I believe these days that there is a tendency frequently to leave them a bit on the sides and somehow not kill them immediately with all the corporate processes and everything else, because you are in a way destroying what you are buying by integrating it too closely. Mantvidas, you have a lot of experience with M&A also. How do you see these cultural, let's say, things around innovation?
I would say innovation is actually very equal to the startup mindedness of the companies, because when you're a startup, basically you're testing a lot of new things, you are experimenting, and basically you are saying that the failure is teaching you. That's the same was, speaking about examples, the same with Amazon. I remember Jeff Bezos once said that basically everyone has to make at least a couple of failures, because it shows that they're testing something new. And only by testing something new, looking for some solutions which everyone is just experiencing them. So I would say that every company should have at least, part of the mindset made as a startup company, looking for something new, looking how to solve, and of course experiencing failures in their path.
Giuseppe, are neobanks better at this than traditional banks?
No, indeed, what I want to highlight is the definition of failure, no? Because if for failure we talk about, okay, the bank invests some money and we don't have a business case or immediate return from this investment, is a topic, and in my opinion is also acceptable by traditional banks. Because banks might have a digital lab, might have some department dedicated to innovation, of course with limited resources. If the failure is impacting the customer, when we talk about security, cybersecurity, there is no tolerance for failure. And of course, we cannot experiment with the money of our customer. We cannot put at risk the revenues or the, let's say, banks together with the customer assets. Therefore, we need to split. If we are talking about innovation with a limited scope and experiment with a precise role, it's possible. And I believe that traditional banks are inclined or will be doing this kind of experiment. Of course, small companies or fully native digital companies have not legacy behind, and therefore they are more agile in experimenting. But again, it's important to split what we define as a failure. Because I agree with Michael, at the end, nobody on the board will approve a project which has a high risk or no business case behind as a pure business activity. But if we manage this as an experiment within our lab, it's a different story.
Okay, so in a way I'm thinking there's sometimes when there are like risk issues or this or that, people do a good bank and a bad bank. Is there, Mihaela, is there an analogy in the innovation space? Like an innovative bank and a traditional bank within one large institution? Is this possible? How do you...
I'm not sure if I understand the question now, but you're talking if in the same institution...
In the same institution, you can somehow, as Giuseppe was saying, separate out the...
Absolutely. Again, you have banks which have, of course, appeared in the last few years, so I wish them all the best that this does not happen to them. But even the most innovative banks started 10 years ago are turning into a corporation with all its rules and obligations, and the innovativeness which was there in the beginning, and the drive is disappearing with the starting line for the traditional banks who are actually learning how to be a modern one, how to be a digital one. It's slightly different, and it usually happens like that you have the more traditional minded people, the more innovative people, these two worlds collide. and on different levels, in different committees, in the different systems and bank processes, it's getting more and more obvious. But the collision, and I would say the conflicts are actually healthy, they're needed. It's not that there is a good and bad, it's just different. Everyone has their job. After all, it is just a job for that. It's nothing personal. It's just that it's really difficult to embed in the usual processes what we now here nicely call the experiments. Once the company realizes that this is exactly what's happening, it's not bad people, good people, new people, old people. It's just different even goals which these people have. Once you manage to align these two worlds, it starts getting easier. But yeah, on the failure, I'm fully with you on the definition of what you call failure. And you were mentioning it's a teaching or learning. When I turn it around, experience. So when I heard you speak, I was thinking, well, the easiest definition of failure is that if you're able to learn from it, and hopefully the cost for the learning was still within limits, then it's a failure you actually want to have and you must have, because it's impossible, also mentioned by most of you, to do something innovative without, and getting it for the first time right. I don't know if any of you have ever done that you got it first time right, or if any of you heard of anyone. I believe you mentioned Bezos. He started 20 times or so to launch Amazon. If he stopped the 19th time, we would never have Amazon, at least not from Bezos. There will be someone else doing something similar. But in our companies, can you imagine going to your board 19 times and they still allow you to try the 20th time? Not really. I usually stop after 7th time, so it's not, but even trying to get something approved, that's usually my limit. Then I say, well, and now I'm part of it, so I should say my colleagues and us as board decide. But when I know 7th time I was not able to explain it, then that was it for me. So there is some space, and the processes are not making it any easier for our innovations.
Of course, the best way is to learn from other failures and mistakes. Then it's, let's say, cost efficient when you're learning from other mistakes. But that's not the case usually in life. Usually you need to try it yourself because you're trying something differently. But I would say I agree with Michaela, because basically it has to be in a mindset of a company that the failures is teaching us, and we need to learn from the failures. Because if the management of the company will not support this mindset, this value in the company, the employees will not even try to do this. So they will be afraid.
And following on that, and also connecting to the poll, so the next item voted highest on the pecking order was leadership. So does it really start from the top? Do you think the top management can instill a culture of innovation into the organization?
I would say that everything starts from the top, but it's not the most important part. I would say it's as a support part. I mean, the leaders, the shareholders or the management, they need to support this style in the company, but it has to be in every employee's mind to try to test, to experiment, and that's why how innovations is being founded.
And then Giuseppe, you're also still quite on the tech side with your responsibilities. If I read these poll results, this is about people seem to be lacking a bit of culture in the bank, which allows them to experiment, which allows them to fail without being sacked the next day. And all these hardcore tech topics come bottom of the list. Is it a big surprise for you, or how do you see the role of tech in this context, where people seem to be saying that they believe these soft factors are more important?
No, I would say I'm not surprised, because actually, I fully agree, the innovation starts also from the leadership. So leadership should have the mindset to allow new idea and to basically support those ideas and allow the people to work on it. So the fact that the technology is an enabler, in my opinion, is not surprising. So at the end, we should look at the processes, the business model, customer experience, and then which technologies should support the idea. So at the end of the day, it's most important the idea and how we improve the life of our customers in order to be successful in the innovation. So there are technologies that are supporting a lot of opportunities, so it's matter to choose the right idea that can make the difference for the organization.
And when you mention organization, do you think the bank organizations reflect these priorities? Because my sense is innovation frequently sits quite close to IT in org charts, obviously depending from bank to bank, but...
I see that some banks are changing this approach. So in some of the cases, the role of digital or information officers is changing. The possibility to be part of the board is more and more frequent in many organizations. So it obviously depends. Probably legacy banks, so banks that are on the market for 20, 30 years have a different approach, and they still consider a business as a key function in the organization, and probably IT as a follower of what the business is basically deciding. But my experience is personally that it's changing. This attitude is changing in the big group, and obviously the small bank or fintech that are in the market for 10 years have a totally different approach. This is obvious. But I believe that these are already a fact. There is no possibility to basically change this status that business and IT should work together with the same shared responsibilities. For example, what I'm seeing in some of the organization, digital person or IT directors or managers will have or are having basically KPI on revenues, KPI on business figures, and the other way around. Basically, some business leader might have KPI on how digital their processes are. So this is also the way how to drive the innovation.
Mihaela, how do you see these organizational topics? How to best organize for maximum innovation?
So the best is to have the innovative CEO, innovative board members, and innovative staff. So that's, of course, the best.
The full flesh.
Thank you for the question. It's, of course, a good one. Then, more seriously, we are lucky enough to have an enlightened CEO without, and I mean even our guy in Brussels, who is in charge of all the 45,000 people organization, because without him, I must say, we would not be doing digital assistance. This always comes on top of the regular budgets. It would never be possible to replace the business as usual stuff, which we have to do. We are looking, as I mentioned, in the crypto usage, in blockchain, and these are all budgets no one would ever approve for me because they will never have a business case in any reasonable timeline. So without an enlightened CEO, it's extremely difficult because all the other people with their responsibilities simply do not have the mandate. So it's very often we call this religion. So we choose some topic as our religion, and in religion you simply trust. It's not about a business case. And this you can only do when there is a CEO. None of the board members has the power. So that's my answer. I agree, it must come from the top. And as for the hierarchy, then it depends. If you have a guy like Steve Jobs, who is then both the visionary at the same time super capable of being technical and looking at the details, that's obviously the best combination. Approachable to people in the sense that he discusses the direct topics. I think it's impossible when you are just a visionary. The charisma and aura will last only that long. So it's good to have a flat structure at the same time in a way. And even if not organizationally, then the flat structure spirit and the cultural hierarchy to be as small as possible to actually enable real innovation. In our case, and while you see me, I now have the IT and all that stuff around it as well. Before I just had the digital front ends for all the client segments with us. But for us, the Chief Inno role started actually from the daily banking, which I also still have. So I'm running the whole product factory of accounts, of payments, of cards, cash, treatment, because this is where the most innovation was happening. So for us, it was not starting from the IT, but now for me, it's the most practical to have all together because I have all the resources, I have the topics, I have the people who can help me move it. I'm also combining in my role, I'm in charge of several of the fintechs which we invested in. So it's a nice combination, I must say, for me, because I'm not just the innovation person who can sit there and you know, cloud nine, think about nonsense every day. Whenever there is an incident, it's me. It doesn't matter now whether it comes from the IT angle or whether it comes from any type of daily banking business. At the same time, I have the pleasure to be in other cultures, in the startup cultures, because of our accelerator and because of the investment. So for me, this is a best combination when your company allows it to do that.
Perfect. Peter, you are...
Yeah, I just wanted to add to Michaela that really, without the CEO and without his buy-in, it's not gonna work. And also, you need to have someone who is decisive enough to actually decide that this is the way we want to pursue, because in banking and in all the sectors which are regulated, you have always the legal people who are not able to do or change. Then you have the risk people who are aware to some of the change. So instead of going to talk to everyone and just you know, take 6-9 months to just pursue and convince everyone that this is what you want to do, you need to have a CEO who will tell you after 2 months, well, let's go for it. And unless you don't have such a mindset, you will basically always do just the evolution, or you will just follow the market and you will never do a revolution, which is, in my mind, what innovation is about, basically.
Thank you. Mantvidas, just tell me, in your view, can banks buy innovation? Like if you think about organically developing something versus buying a company which has the product you need, how do you compare these two strategies?
They're both good. I mean, it depends on the situation. Of course, if you want to make it faster, you usually buy. But you know, usually it's up to very good due diligence if you're really fit to each other, because I tried several times, and basically all the times was, you know, different experiences. So I cannot say that there is one rule for everything, that you know, you check everything, and if you know, make positive marks, then it will work. It will not, because usually it's every time it's a different experience. You know, different users, different customers, different people, different technology inside of the companies. So you know, you should decide on each and every situation whether it is better for you to grow organically or to buy someone to make it faster.
Perfect, thank you. At this stage, do we have a question from the audience, maybe? Would some of these mics? Ah, excellent. Please.
Yes, hello. So we're going to an insightful discussions, and I think Peter was touching also this mortgage as a very traditional business, and also some of the other speakers touched that part. So what is your vision in very practical ways, because we spoke about kind of very high level also kind of trends and all that stuff, but very practically, this traditional mortgage business, where do you see it in 3-5 years? What will be different from where we are today in providing the service to customer, you know, selling it, maybe fully digital, no people involved, total commodity? I don't know where we are heading.
I will start as I touch upon to this. In 3 to 5 years, I think it's tough to say, but in my point of view, in case we will be able to challenge the traditional way of how we sell mortgages, so that's usually in all the markets in CEE over the brokers, then we'll be able to go more and more digital, because you need to convince the people that they are able to do the mortgage themselves. And in case you will be able to do that, that they don't need a partner to talk to, they don't need someone who will be able to explain to you all the nitty-gritty of the mortgage contract, etc. And also, if you will be able to convince people that they can use digital signage, they can use bank ID for identify themselves, then in 3 to 5 years, you can have a fully digital mortgage on the market. The question for me is how the market share will look like of such originated mortgages. Because right now, there are markets, for example, in Finland or Sweden, there are neobanks which are able to provide you with the online mortgage. Also, we in Moneta, we are able to do online refinancing of the mortgage. The only thing which we are not able to do online is the cadastre, where you still need to go and sign the documents, etc. So, however, the market share of such originated mortgage is very small, because it's not about the innovation that the banking market will be not able to adjust and do online. It's more about the sales process and about the mindset of the people and about the revolution in the brokerage services. Because, you know, 1.5% of commission, that's very, especially in mortgage, which is usually bigger tickets, this is very much intriguing. And I think, you know, in that way, you will have to convince people that they don't want to pay this and they want to have cheap service which is online. That's my view.
Perfect, thank you. We are approaching an end. I'm looking out. Please, one more question, and then we.
Thank you for your interesting discussion. As the topic is about the innovation, right? So I would like to ask you about your belief. So the question will be to everybody. Do you believe in digital euro? And do you track the developments from the ECB on that sense? Thank you.
I'll be super short. It's unavoidable. It's not about belief.
Also very short. It started already. I don't think that you cannot believe that. I mean, it's already running.
Okay, perfect, thank you. So maybe if we could make just like everybody, just 1, 2 sentences, final statements. Ah, sorry, there's a... Last 2 super quick questions, please. Peter will kill me. So please.
Sorry, I mean, but I need to read it fast.
No worries, no, please do.
I'm an ex-banker who moved to the technology side, so for me that's quite interesting. Previously, what I would say, as Mihaela mentioned, usually since the responsibility is so big when you're doing any digital changes, you're, I mean, prone to hire some, some consultants, I don't know, some McKinsey who is doing the mapping, building the, the business case behind it. They propose you 30 different initiatives, then you choose where to go. Do you think that banks are changing right now towards the other, approach when someone from business, from within your company is coming and saying, you know what, we need to change that, and probably I even know the vendor outside on the market, take a look at this. Do you see that's a possible thing, and do you think it's a positive change?
So maybe, and I use this as my final sentence at the same time, although I will then, obviously, if the question comes from me as well. We haven't hired McKinsey, nothing against McKinsey for the last 10 years, and it's nothing against McKinsey or anyone else. We actually believe in the internal innovation and the internal ideas. Again, partly linked to our CEO, all our strategy, all our innovations, all our, we have full strategy, STP, data, real-time data, everything coming together, then on top our digital assistants, without which this will not be, this is all our internal stuff.
I would also add that if companies are just looking or listening to external consultant, of course this is not true innovation. It's just being a follower or smart follower of other ideas. So at the end, the innovation should start from inside the organization. So presenting some idea and believing on this idea. Otherwise, it's just following what the market is demand as normal way how to do business.
Perfect. And the very last question, please. Mike is coming.
No doubt that the innovation, the digitalization is the future. But how important or what is the role of the education, of the culture of the country where these products are developing?
Peter, or whoever.
Like education, I think that, you touched a very important topic in innovation as such, because it's not just about to go and buy something. You also need to have the ability to use it and maintain it. So I think that we need to be focused on both directions. Innovation in a digital way, so developing and delivering and giving to the customers something new, something tangible. and then also give them a nice customer experience. And there you need the educated people who are able to work with what the IT develops. So for me, this is an integral part of the innovation as such.
I do agree. I can give you a couple of examples. In Hungary, for example, the country forced all the banks back in 2020 to implement instant payment by regulation. So all payments, retail, below a certain threshold, which is quite significant, must be instant. So this is different from other countries where there are instant payments, of course, as optional services. So this is a case, in my opinion, where the local cultural approach drive the changes. In Czech Republic, for example, another interesting concept is the bank ID, as Michela mentioned before. So the country is forcing the banks to create a digital ID for customers. Therefore, I think that indeed the cultural and the specificity of the market are really important in the evolution of the idea and the evolution of the market.
Thank you, Giuseppe. And
So
then,
just as a final
if you can also use this
basically,
as a final statement, yes, please.
Yeah, also related to education and people, because we see this innovation which is currently happening is just, I would say it's initial stage, basically it's just starting. And in order to continue and to foster it, we need to invest more, but invest more not to innovation as itself, but to innovators. So to those people who will be innovating it. So it will be the best investment of a company who will need to adjust to the changes in the market for the future, basically, because the innovators will adjust and do the innovations for the company and for the processes, business models, and so on.
Perfect, thank you. Perfect closing for our panel. Many thanks to all the panelists for very interesting discussion. Great also to all of you for many questions. Now we are entering break, and Peter, we will be back at... Sorry? 10:20. Thank you all.
In recent years, amazing customer experiences have become the new standard. It's what we all expect as consumers, to be understood and treated as individuals. But no matter how great these interactions become, there's always room to improve, to make them more consistent, more seamless, more personalized. For instance, when you deliver a great new marketing offer, it was likely built with different data, using different tools than other operations like risk management, financial crime protection, or even your supply chain. As a result, when customers move throughout the customer lifecycle from one touch point to another, each interaction is not as valuable or even as enjoyable as it could be. This is a growing problem for companies in every industry because personalization is king, and companies that offer disjointed experiences are quickly falling behind. That's why we built the FICO platform. It allows you to create amazing customer experiences with outsized business results. The FICO platform is a complete solution that enables you to easily connect your data while applying the latest AI, machine learning, and analytics to uncover insights which you can then put into action across your organization. In most companies, their IT structure looks like this, with each system built on its own island. With FICO, we bring your data, analytics, and application development together on an open, unified AI decisioning platform. This makes building new applications a breeze, because now you don't have to start from scratch. All you have to do is define the functionality you're looking for. And by empowering business stakeholders to collaborate with data scientists and application developers, you can work together to simulate, test, optimize, and deploy highly effective decision strategies. And you can do it fast. With the FICO platform, all your applications will operate from the same 360-degree view of the customer, So the important decision assets, like data characteristics and predictive models that are created by one department, will become available to the others, creating a centralized, responsibly governed system of action that creates better experiences for every one of your customers at scale. It's time to realize the power of a unified platform for digital decisioning. The FICO platform. Get started today.
Banks and credit unions have a problem. Their outdated technology can't keep up. Not with the engaging experiences of big tech and challenger banks, or the speed of new fintech services. And especially not with growing customer expectations. So financial institutions can either lose their customers to better digital players, or they can upgrade. And that's where we come in. The Backbase Engagement Banking Platform is the evolution of the digital banking experience. With the power of one platform, you can start small, then grow big across all channels and business lines. You can increase conversions during onboarding and product applications, deepen customer loyalty and engagement, partner with the finest fintechs, and above all, improve life for customers and also employees. With turnkey apps plus accelerators to build your own, the platform can be tailored to the unique needs of any sized bank or credit union, like the hundreds around the world that we're powering today. This only scratches the surface of what Backbase can do for you. To learn more or speak to us, visit backbase.com.
Ones, zeros. An entire world made up of ones and zeros. A digital world, complicated and dangerous. Anywhere we find ourselves, anywhere we're heading, unlimited possibilities in the palm of our hand. One touch and we can pay everywhere. Absolutely everywhere. Control our money and our accounts without having to go to the bank. Comfortably, 24 hours a day. We can finally work from anywhere, safely, easily, even from there, or from there. Nothing stands in our way. We can prove our identity 100% whenever necessary. The digital world is astonishing. We are here to fully exploit all of its benefits, Monet Plus, and applied cryptography. We change ones and zeros into unique services and zero risks. We are Monet Plus. For a quarter century, we have been helping people use their digital identity and their money comfortably and safely. Anywhere, anytime. Monet Plus. Digitally, anywhere.
It's a real-time world, in the workplace and in our personal lives. We expect speed and simplicity in everything we do. Payments are no exception. At ACI Worldwide, we're providing mission-critical, real-time payment software to corporations around the globe. Whether it's two friends splitting a bill over lunch, a student making sure tuition is paid on time, shoppers paying instantly online, or an insurance company dispersing funds for a claim. Our software helps make real-time payments a reality for consumers and businesses globally. Because customers are demanding real-time, and governments are mandating it. Thousands of banks, merchants, and billers rely on ACI to meet the evolving real-time payment needs of their customers, helping them pay with any device, through any channel, in any currency, anywhere in the world, with an experience that's fast, simple, and secure. ACI Worldwide, the leader in real-time payments.
In recent years, amazing customer experiences have become the new standard. It's what we all expect as consumers, to be understood and treated as individuals. But no matter how great these interactions become, there's always room to improve, to make them more consistent, more seamless, more personalized. For instance, when you deliver a great new marketing offer, it was likely built with different data, using different tools than other operations like risk management, financial crime protection, or even your supply chain. As a result, when customers move throughout the customer lifecycle, from one touch point to another, each interaction is not as valuable or even as enjoyable as it could be. This is a growing problem for companies in every industry, because personalization is king, and companies that offer disjointed experiences are quickly falling behind. That's why we built the FICO platform. It allows you to create amazing customer experiences with outsized business results. The FICO platform is a complete solution that enables you to easily connect your data while applying the latest AI, machine learning, and analytics to uncover insights which you can then put into action across your organization. In most companies, their IT structure looks like this, with each system built on its own island. With FICO, we bring your data, analytics, and application development together on an open, unified AI decisioning platform. This makes building new applications a breeze, because now you don't have to start from scratch. All you have to do is define the functionality you're looking for. And by empowering business stakeholders to collaborate with data scientists and application developers, you can work together to simulate, test, optimize, and deploy highly effective decision strategies. And you can do it fast. With the FICO platform, all your applications will operate from the same 360-degree view of the customer. So the important decision assets, like data characteristics and predictive models that are created by one department, will become available to the others, creating a centralized, responsibly governed system of action that creates better experiences for every one of your customers at scale. It's time to realize the power of a unified platform for digital decisioning. The FICO platform. Get started today.
Banks and credit unions have a problem. Their outdated technology can't keep up. Not with the engaging experiences of big tech and challenger banks, or the speed of new fintech services. And especially not with growing customer expectations. So financial institutions can either lose their customers to better digital players, or they can upgrade. And that's where we come in. The Backbase Engagement Banking Platform is the evolution of the digital banking experience. With the power of one platform, you can start small, then grow big across all channels and business lines. You can increase conversions during onboarding and product applications, deepen customer loyalty and engagement, partner with the finest fintechs, and above all, improve life for customers and also employees. With turnkey apps plus accelerators to build your own, the platform can be tailored to the unique needs of any sized bank or credit union, like the hundreds around the world that we're powering today. This only scratches the surface of what Backbase can do for you. To learn more or speak to us, visit backbase.com.
Ones, zeros. An entire world made up of ones and zeros. A digital world, complicated and dangerous. Anywhere we find ourselves, anywhere we're heading, unlimited possibilities in the palm of our hand. One touch and we can pay everywhere. Absolutely everywhere. Control our money and our accounts without having to go to the bank. Comfortably, 24 hours a day. We can finally work from anywhere, safely, easily, even from there, or from there. Nothing stands in our way. We can prove our identity 100% whenever necessary. The digital world is astonishing. We are here to fully exploit all of its benefits, Monet Plus, and applied cryptography. We change ones and zeros into unique services and zero risks. We are Monet Plus. For a quarter century, we have been helping people use their digital identity and their money comfortably and safely. Anywhere, anytime. digitally anywhere.
It's a real-time world, in the workplace and in our personal lives. We expect speed and simplicity in everything we do. Payments are no exception. At ACI Worldwide, we're providing mission-critical, real-time payment software to corporations around the globe. Whether it's two friends splitting a bill over lunch, a student making sure tuition is paid on time, shoppers paying instantly online, or an insurance company dispersing funds for a claim, our software helps make real-time payments a reality for consumers and businesses globally. Because customers are demanding real time, and governments are mandating it. Thousands of banks, merchants, and billers rely on ACI to meet the evolving real-time payment needs of their customers, helping them pay with any device, through any channel, in any currency, anywhere in the world, with an experience that's fast, simple, and secure. ACI Worldwide, the leader in real-time payments.
In recent years, amazing customer experiences have become the new standard. It's what we all expect as consumers, to be understood and treated as individuals. But no matter how great these interactions become, there's always room to improve, to make them more consistent, more seamless, more personalized. For instance, when you deliver a great new marketing offer, it was likely built with different data, using different tools than other operations like risk management, financial crime protection, or even your supply chain. As a result, when customers move throughout the customer lifecycle, from one touch point to another, each interaction is not as valuable or even as enjoyable as it could be. This is a growing problem for companies in every industry, because personalization is king, and companies that offer disjointed experiences are quickly falling behind. That's why we built the FICO platform. It allows you to create amazing customer experiences with outsized business results. The FICO platform is a complete solution that enables you to easily connect your data while applying the latest AI, machine learning, and analytics to uncover insights which you can then put into action across your organization. In most companies, their IT structure looks like this, with each system built on its own island. With FICO, we bring your data, analytics, and application development together on an open, unified AI decisioning platform. This makes building new applications a breeze, because now you don't have to start from scratch. All you have to do is define the functionality you're looking for. And by empowering business stakeholders to collaborate with data scientists and application developers, you can work together to simulate, test, optimize, and deploy highly effective decision strategies. And you can do it fast. With the FICO platform, all your applications will operate from the same 360-degree view of the customer. So the important decision assets, like data characteristics and predictive models that are created by one department, will become available to the others, creating a centralized, responsibly governed system of action that creates better experiences for every one of your customers at scale. It's time to realize the power of a unified platform for digital decisioning. The FICO platform. Get started today.
Banks and credit unions have a problem. Their outdated technology can't keep up. Not with the engaging experiences of big tech and challenger banks, or the speed of new fintech services. And especially not with growing customer expectations. So financial institutions can either lose their customers to better digital players, or they can upgrade. And that's where we come in. The Backbase Engagement Banking Platform is the evolution of the digital banking experience. With the power of one platform, you can start small, then grow big across all channels and business lines. You can increase conversions during onboarding and product applications, deepen customer loyalty and engagement, partner with the finest fintechs, and above all, improve life for customers and also employees. With turnkey apps plus accelerators to build your own, the platform can be tailored to the unique needs of any sized bank or credit union, like the hundreds around the world that we're powering today. This only scratches the surface of what Backbase can do for you. To learn more or speak to us, visit backbase.com.
You're at the panel later, right?
Yes.
Okay. So, hi to everybody. Welcome back to the main stage. Next module is about trends in the CEE region. Similar like in the morning, we will have 2 presentations followed by a panel discussion. First presentation is about regulatory development in the banking sector by Sébastien de Brouwer. And Sébastien de Brouwer is Chief Policy Officer at the European Banking Federation. He's a member of the EBF Senior Management Committee, and Sébastien is also supervising all EBF policy areas as well as horizontal functions such as international, public, and legal affairs. As part of his activities, Sébastien is also a board member of the European Payments Council, a member of the European Banking Authority, Banking Stakeholders Group, and a member of various experts groups at the EU level. Let's have a warm welcome for Sébastien, please.
Thank you, Domagoj. Thank you for the introduction. Looking at the slides, yes, it works. Very good. Ladies and gentlemen, it's of course a pleasure for me to be here today. At this quite interesting conference so far. I think one of the first in-person conference. So thank you for that, and congratulations, of course, to Connectiva. So I'm joining you as indeed representative of the European Banking Federation. The European Banking Federation is the federation regrouping the National Banking Association of all EU member states and the EFTA EEA countries. And I will indeed, well, say a few words or try to update you on the current situation of banks in Europe. And you see a picture of a storm. And also, and that's as a matter of background. And then also give you a brief update on the main regulatory themes for 2022-2023 at European level, which of course impact also banks in the CEE countries. Of course, it would take me hours to really go in depth into the update of the regulatory framework. So I will try to focus on a few, I would say, regulatory initiatives, which I believe are the most important ones. Now, first, the current contexts or the top banking industry trends and themes for 2022-2023. I think we can say that I mean the financial sector is used to changes. There were so many in the last decades that we should, at the end, well, be used to it. But I think we can say also that current times are quite special. Some of us speak about the perfect storm. It's not, I would say, a language that is coming from the EBF itself. But after a long period of stability, geopolitical, economical stability, we are once again, I think, being buffed in by the shock of change. I think almost every day a new challenge or a new vulnerability or new threat is coming or is appearing. COVID-19 was, of course, first. It showed how vulnerable we were to diseases, and it has left, I would say, our economies facing huge debts. We have also the brutal war in Ukraine, which has exposed the vulnerabilities of Europe to defense, security, also to the energy supply, so the energy policy. We know also that this war is much more than about Ukraine. It's likely to create a profound and lasting geopolitical changes, as well as long-term economic effects. It's of course impossible to say exactly what these will look like at the end. We all see also challenges or vulnerabilities related to climate change, be it floods, be it droughts. Population are aging, birth rates are falling, so which represent also an important demographic challenge. Technological change, digitalization, while on the one hand bringing enormous benefits, is also disrupting our existing social and economic models. Geopolitical tensions are rising, as I mentioned. We're seeing more political, populistic, nationalist agenda. Decades of integration and rising global trade are going now into reverse. And if all of that was not enough, after a long absence, we are now also experiencing record inflation, due notably to the energy crisis. And this has, of course, serious repercussions. We can feel it ourselves. I think massive squeeze in household income, sharp drop in living standards for citizens across Europe. And it's a shock which is affecting, I think, businesses also in every sector of the economy, with perhaps a few exceptions. So all these increase the likelihood of a global recession. And I think this made also one of the CEO of the largest European banks say in a recent conference that in more than 30 years of banking, he had never seen such a culmination of risk that we have to deal with at the same time. So most likely 2023 will not be an easy year across Europe and the world. Those are short-term challenges and more longer-term challenge. We need to fix them and then at the same time setting the right course for the longer term. Because as I mentioned, those challenges of demography, those challenges of digitalization and the green transformation of the economy will last for some times. So now, if we look at my slide, and I don't want you to be depressed, of course, I can perhaps still mention some additional ones impacting directly or indirectly the banking sector. So in addition to the exogenous factor, you have, of course, increased competition in the financial sector with the fintechs, the big techs. You have opportunities linked to the digitalization, but you have also more risk, with notably cyber risk. You have the emergence of crypto, CBDC, and the digital euro. We'll come to that later. It's a game changer, or it could be a game changer. And also, I think in our sector, you have an intensification of the war for talent, so which creates also issue for the sector attractiveness. No, I believe that all these challenges, despite coming in many forms, have perhaps one thing in common. They all lead to increased demand of public spending. At the time, most European governments are already heavily indebted, notably after COVID, and also at the time where corporate SMEs have their margin rather squeezed. So, no, the only possible long-term answer to this difficult situation is more growth. And also in the short term, I think the only political and business response to the problem will be more borrowing. So servicing the debt depends on growth. Paying for the green transition depends on the growth. Paying for more defense depends on growth. Supporting an aging population depends on growth. So why this is so important? because it means, of course, that banks as engine of, the financing of the growth have a very important roles nowadays and will have a very important roles in the future. We believe that banks are actually in a rather strong position to help the economies, not just to weather the storm, but also to power the growth we need. And if you look at the banks, I think the banks in Europe have also changed. I think they are now a source of resilience. They were perhaps the cause of a crisis more than 15 years ago, but the world has completely changed. European banks have built up more capital than ever, more even than the US counterpart, more than 250 billion euros since 2014. So we came through the systemic shock of COVID intact, and more than that, I think we were part of the solution, supporting customers and lending to business. Capital and liquidity buffer are still at very robust level. I think CET, so core equity tier 1 capital, fully loaded ratio is at 15%, unchanged compared to the last 2 quarters. So banks are robust and well capitalized. Now the main motto, and I will stop with that with my general introduction, for us is really advocating for growth, but also regulating for growth. We strongly believe and we advocate towards the institutions that actually every regulation should have now as a main policy objective growth. We all need to reflect on that and take into consideration when we legislate or when we regulate in Europe. I could add also, of course, the objective of strategic autonomy and also the objective of competitiveness, because we are also lagging behind in Europe in many sectors. Now, if we have the right framework, right regulatory framework, right legislative framework, I believe banks will be able to continue to lend and finance all the investment needed to meet the many challenges, short-term and long-term. So we need simpler regulation that support those investments. This is about the general introduction. And it's very important also when it comes to the more, I would say, specific initiative, because in each and every meeting we have with European institutions, we advocate again these aspects. Do not impede, I would say, the role of financer of the banks, but to the contrary, support it, because that would help also Europe. Now, if I look at the ongoing regulatory development in 2022 and 2023, one thing is clear, and it was clear also earlier on, regulation is and remain a very important driver of business, banking business Europe. And this is very clear when you see the number or the level of initiative still ongoing at the European level. So almost 15 years after the financial crisis of 2008, which has already completely redefined the banking regulation framework, regulation still very much matter. It's not only about financial stability, but also touching many other aspects of banking directly or indirectly. Now, in my next slides, I've tried to regroup the still many legislative or regulatory initiative currently discussed or announced at EU level under 8 themes. You have initiative belonging to the banking prudential regulation, to the completion of the banking union, to the capital market union, to digital finance, to sustainable finance, to retail financial services, to payment and to the fight against financial crime. If I start with the first theme, the initiative related to banking, prudential regulation, I think one of the main initiatives, you all know it, is of course the transposition of the Basel Agreement, or the Basel Endgame Agreement, the Basel IV, as some mention it or name it. It's key for bank. It's still a reminder of the post-2008 crisis reform. And it has taken the form of a banking package at European level with the review of the EU banking rules, so the capital requirements regulation and the capital requirements directive. The main aim of the Basel III Endgame was to address the possible deficiencies in internal models, try to reduce the excessive variability of banks' risk-rated assets, and try to ensure that those models didn't or do not underestimate risk. Also, with an additional objective of making it easier to compare risk-based capital ratios across banks. Now, the banking package also proposed additional requirements to strengthen the resilience of the banking sector to ESG risk. So the proposal will require notably banks to systematically identify, disclose, and manage ESG risk as part of their risk management. This would include regular stress testing by both supervisors and banks themselves. Supervisors themselves will need to assess ESG risk as part of their regular supervisory reviews, and banks will have to disclose the degree to which they are exposed to ESG risk. Now, without entering into too many details, our position on the banking package is that while we acknowledge that the European Commission proposal has taken into account some of the EU specificities, we also believe that more needs to be done, and notably more permanent solutions need to be adopted, really to ensure that there would not be any significant increase in banks' capital, which was one also of the objective of the EU institution, notably the European Council. And this is again very important in this context of supporting growth, because otherwise, if it would increase bank capital significantly, it will reduce the capacity of banks to finance the economy and to fund the important transition of digital transformation and sustainability. Now, just to give you one example, which is a very striking one, unrated corporates exposure will be assigned, or the proposal is to assign a much more important risk rate. And that's what's required by the Basel Agreement, so 100% risk rates. The problem in Europe is that most of the corporates are or do not have any external ratings, and the framework is not yet there to allocate ratings to all those companies. So that means that they would be penalized regardless of the real credit quality of the corporates. No, the Commission has proposed a transition phase, with reduced risk rate for if some conditions are met by those corporate. We believe that actually this temporary nature of the proposal should be reviewed. It should become more permanent, or at least should be replaced by a clause that preserves the transitional arrangement until the condition is met that the vast majority of European corporate exposure are covered by eligible external credit rating. And that goes also for real estate mortgage. There is also a transition phase we call also for more permanent solution. Now, Discussions are still very much ongoing. That takes, I would say, most of our time at the EBF now. Discussions are ongoing with the Parliament and with the Council. They both have the objective to come to an agreement, both at Council and Parliament, by the end of the year. There is more chance that this will happen at the Council level under the Czech presidency than at the Parliament, which has to face some delay. I think there were more than 1,500 amendments to the proposal, so they all have to be discussed. And when they come to a final agreement, they will start discussing at trilogue level. In this team, I should also add the review of the macroprudential framework. This is very much looking at the macroprudential toolkit for banks, which has been applicable since 2014, notably the possibility, or just to make sure that banks are able and willing to use the capital buffer, systemic risk buffer, countercyclical buffer, etc. And I should mention also the prudential treatment of ESG risk. I think we may come back to that also in the next panel. The second theme relates to the banking union. I will not elaborate on that. It's not yet about the EDIS, the Mutualized European Deposit Insurance Scheme, where there is not yet sufficient support at member states level. It's more about strengthening the resolution framework for small and medium-sized enterprise. The third theme is about the capital market union. So a lot of initiatives ongoing there as well. So capital market union remains a work in progress. There are new initiatives like simple rules for settlement of securities, establishment of the European single access point, and many others. I think you have the list in front of you. Next theme is everything related to digital, the Digital Operational Resilience Act and the regulation on market in crypto assets regulation were recently adopted. What is coming now is an open finance framework. I think this was also discussed in the previous panel. The Commission will come with a proposal in Q2 2023. And the aim of such framework is to allow customer data beyond the scope of PSD2, so payment-related information, to be shared and reused by financial services providers for creating new and improved services. So there are reference to credit data, consumer credit, mortgage credit data. Again, I think we can make the link with the previous panel. And also, for instance, investment preference data. So more to come. I should also quickly mention the digital euro here. Very important initiative, of course, for which the ECB is already working on a pilot. This could be a game changer. We speak about the possible launch by 2026. So it looks far away, but actually the ECB is already moving quite quickly on the possible feature, possible design of the digital euro. And we're of course very concerned also for two or three main reasons. First, it could have a strong impact on the bank deposit, so eroding the bank deposit base of banks, which is of course an important, secure, stable and cheap sources of funding for banks to lend to the economy. Now the ECB seems to be aware and try to avoid as much as possible the negative impact for the intermediation of banks. They speak about a cap of holding digital euro, possibly 3,000 euro, and a tiering system where holding an amount beyond a certain threshold would be penalized. Still, repercussion could be very important, so very important to closely monitor. Second issue, it poses also challenges in terms of payments, because it's also the arrival of a new competitor in the payment market, or at least part of it, because there as well the ECB wants to play a role. And last but not least, it spells a challenge also to the relationship banks want to maintain with their clients, because, well, non-bank services providers might also offer a digital euro wallet. Sustainable finance, I will go through. We have a panel just after. We can speak about that at that time. Retail financial services, quickly, revision of the Consumer Credit Directive, possible revision of the Mortgage Credit Directive, a revision now also already ongoing of the distance marketing for financial services, and also the Commission will come with a new retail investment strategy, which will be very much about inducement, transparency requirements, and so on. Then I go to the seventh theme, payments, and I go quick because I know I'm starting to run out of my time. I think it was just mentioned that Romania has already imposed mandatory instant payment. Actually, the regulation coming from the European Commission is also about requiring banks in the European Union to offer and receive instant payments, so mandatory for a fee equal or lower to lower than for a traditional credit transfer. It's also about deploying the services that would allow payers to validate the account name and account identifier of the payee, so IBAN check, prior the authorizing of the payments, so it's referred to as the confirmation of a payee scheme, and some additional requirements. And then we'll also have the review of the PSD2, also coming in Q2 2023. Last theme, and I will just mention it, is about the revision of the AML framework. The Commission came there with 4 legal instruments, a regulation, a directive, also new regulation establishing a new AML authority, trying to address the supervisory fragmentation, so a new AML authority at European level, which will directly supervise the more risky institution, and then the fourth instrument, the fund transfer regulation, which has extended the reporting obligation of payment service providers in the field of crypto assets. Voilà, that's a long list, which actually is far from being complete. But I come now to my concluding remarks. I think in this unprecedented level of uncertainty and volatility, one thing which remains quite certain at European level is that indeed the number of regulatory and legislative initiatives remain very high and will continue to be a very important driver for banking business in Europe. As you can see, it's almost a never-ending story, and although we call now for some kind of regulatory pause, we have not yet achieved that, far from it, unfortunately. I'll stop here, but I'm happy to answer any questions. Please.
In order to allow the banks to develop further, to increase.
That's what we are calling for. I'm not.
Yes.
I didn't say that the ECB is.
Yeah, but my question is, what is the basic scenarios for the near future developments?
You mean in terms of capital?
In terms of evolution of events. which, how to say, which is the base for this conclusion of ECB for these guidelines, which are very welcome by the banks, and we are happy for that. But what are the main?
I think again, I didn't say that the ECB is calling for lower capital requirements.
Not lower, but no significant increase.
No significant. That's actually what the EU institutions themselves were committed to when they, initiated the implementation of the Basel IV endgame or the Basel III endgame package into this banking package. They committed to come with a proposal which would not significantly increase the capital of banks. Now, there is a lot of debate of what does it mean significantly. Still, we expect, of course, a rather important increase in capital, which will be caused by the banking package and notably the implementation of the output floor at European level. The European Commission has tried very much to smooth a transition by phasing in the requirements until 2032. But still, if you look at 2032, when those transitional arrangements will end, it could still have a significant impact, perhaps mostly for those banks using internal models, of course, and less for those using standardized model. But still, so it depends very much on the business models of banks as well. Perhaps, those who have a more important mortgage portfolio maybe eat more than others. So it's not even, I would say, for each and every bank. Now, what we say, is that this is very critical, and so to choose the right, I would say, options when discussing those requirements now, because if it's harming the capital base of banks, this will have a direct impact on their lending capacity. And actually Europe, all around Europe, all countries needs more, for the time being, is a capacity of banks, mostly because we are bank financing economy in Europe, to continue lending to the economy. There is huge investments needed, as you know, notably in the context of the climate transition or the green transition, in the context of the digital transition. Voilà. So I hope that I answer partly, at least, your.
My question was the basic scenario for the month or the year to come. Because if there will be a lot of uncertainties.
Yeah.
And
well, the basic scenario, if you look at 2022, we have discussed that recently. I think so far, the banks are still very robust. They do not see yet a deterioration in asset quality. No, of course.
On the contrary, yeah,
for
the time being, and
for the
profits and
voilà.
the rest.
Profits are still very important, but we know most likely that this will come a bit later. If you look now, for instance, the stage 2 on non-performing loans or close to non-performing are increasing. Not the non-performing loans yet, but the stage 2 level is increasing for the in the credit portfolios of banks. So this could announce some deterioration of the quality of assets in the future in 2023. Now, this will most likely require banks to provision, which they have done during the COVID. They still have, provision now, and they may provision a bit more. No, voilà, our basic assumption is that the banks will be able to resist the shock, but of course, and then I link to the regulation aspect, please do not harm further through regulation the capital basis of banks by increasing their capital requirements.
Perfect. And
Well,
Sebastian?
we can enter perhaps in a longer discussion.
Sebastian will be with us also for the panel, and he's staying here, so I'm sure there will be opportunity to continue this. Sebastian, thank you very much for your very structured overview of regulatory happenings, and there seems to be a lot of action. Round of applause for Sebastian, please. Our next speaker is Dario Jankovic from NCR. So Dario is somebody who knows the cards and payments industry in much detail. He started his career working for leading banks in Bosnia, then moved to work for Transacti, which then transformed into First Data, into SIA, into Nexi, ending there as head of business development for CEE. And now he's been with NCR for 3 years, working as a solution sales specialist payments. Dario, floor is yours.
Thank you for the introduction, Domgoj. So, anyway, how I can play the presentation, or someone can assist me with this one. So why this gets on, just want to share with you that I'm very happy to be here in Prague for the first time. In the past 20 years, I've been traveling across the Europe, but this is my first time here. So. Okay, great. So I'll talk with you today about kind of like innovation journey we had experienced past a couple of years when we were actually doing some innovation in card management systems. And you know, everyone knows that card management system is a system that takes care about the cards before they're issued, while they're issued, and after the closing. But also it is required to interact with a large number of the external systems. So either to manage the pins, either to do some of the limit management, for the data to be entered, for the reporting. Also, it is required to fill in some compliance requirements and some similar other stuff. And you know, there are a lot of solutions out there, but what we have found out is that traditional CMS solutions, card management solutions, were designed in the 90s. They have been built up, but never actually re-architectured. They have kind of siloed architecture where you have different processes running just specific streams, and it was not so easy to adapt to the new technologies. And also they're using technology stacks that have been very popular these ages. I don't say that these technology stacks are bad, but it's very difficult to find people, resources, and also to integrate them with the new requirements. Another thing is that all these solutions have been process-driven, meaning that you have daily batches, night batches, processing all the data mainly in batches. So if you wanted to do something in real time, it was quite challenging because you need to wait for the batch process to happen. It's scheduled. And sometimes require specific hardware. So some of the hardwares are out of the life support. Also, if you are connected to the hardware, you have to be very cautious on the upgrades that you need to do. So besides doing the upgrade of the application and the maintenance, at the same time, you have to take care about the hardware and then managing and making sure that you have enough hardware to run the system, to have enough CPU, to have enough risks and other stuff. And in order to work with the other applications, you needed to have developed a large number of satellite solutions that had to enable you to interact with them, to support new interfaces. So traditionally, if you want to have XML interface on some of the old systems, would be challenging. So based on these things, I'm having movements on this one, but not on this one. Sorry. So if you can be my finger, I'm also happy. I can say when to change to the next slide, so no issues. It happens, the gremlins and other stuff. I can tell the jokes, or I can stick with this topic, so I can try my career as a stand-up comedian, because I mean, also I have this Marilyn Monroe mic, kind of like excited about it as well. So, but generally, you know, if you want to design a new solution, you put a blank piece of paper and you start putting on the requirements. So, what would be the requirements? I mean, first thing, you want to have a solution that is totally independent of the architecture. So you want to run it on anything, regardless of whatever you have as a hardware stack. You want to be separated from the hardware. That's one of the, I would say, key things. Second thing, you want to be flexible, meaning that, we're back. So you want to be flexible, which means that you want to have. Oh, yeah, okay, good.
Let's try this one.
Okay, thanks a lot. So you want to be flexible, to be total owner of your business process, not to depend, because if someone else designed a solution for you, you depend on the way how they've been thinking and the way how they have constructed something. So if they believe that certain process should go ABC and you need BBC to go, then it's kind of a challenge. And you want to be able to extend. So you want to interact with the other systems. You want to have a capability to build an API to be able to connect to other systems in 2-3 days. So not to develop an interface that needs to recompile, then have to retest, and you run it, and then you have to assign a new process to it and do something like that. And then you want to have a list of online or available components that are over there, but also you want to build up something of your own and compile it and run it quite quickly. You want to do it in the cloud because you want to have elasticity. So if your volumes grow up, you just don't think about it. The cloud takes care about it. So most of the current systems are designed in a way that you usually have, I don't know, 1,000 transactions per minute, but then during the peak season, this number goes to 2,000. And then in order to be sure, just 100% sure that your system does not fail on that very particular day, you design your system to have 3,000 transactions. So actually you have a capacity to run 3,000 transactions during the year. And it is almost kind of like 2.5 times more than you would actually need. So you want to have a cloud. So once you need more CPU, once you need more memory, the cloud takes care about it and enables you. And you don't want to do a lot of coding because coding takes time. You code, then you test, then it doesn't go well, and you code again, and you compile, and again you have to test. So instead of that, you want to have a system that is able to provide you configuration. So configure over the code. And then you want to have a business analyst that is able to sit down. He knows the process, he knows the configuration, and he wants to manage the flows easily. Building all these things, it's nice for you, but what does it bring for your customer? How are you going to bring real experience for a customer? So if we talk about the payments, everyone was saying, okay, what's the customer expectations during the payments? What's the customer experience in the payments? Well, there's none, because customers don't enjoy paying, they enjoy shopping. The payment has to be quick and fast, and you have to do other things to make them that they feel secure, meaning that you can provide them tools how they can secure their payment instrument. They want to have a hassle-free shopping, meaning that they can do all the type of the transactions easily. They want to select the way how they want to pay. So I have an iPhone, I want to pay with an iPhone, or I have a plastic card and I prefer to do the card, or I have a watch and I'm in the gym, I want to pay. So, and another thing that you want to do is that you want to have everything under a single central platform. So you don't want to have separated streams, you don't want to have separate satellite applications, user management, so add a user to the subsystem B, but don't you add it on the subsystem C and things like that. And then you want to follow all the latest banking industry architecture standards. And you want to be able to integrate with the other systems, because card management system cannot exist alone. It has to interact with many other systems. And that's the, where you have to have a lot of plugs onto it, but they have to be standardized. And again, if you're running a solution that you're in a regional bank or international bank, so you want to have a centralized solution, you want to have a multi-tenant solution, you have to have a single platform for multiple of your customers in order to be kind of like having the same stack and shared on resources and costs. So if you put all these, as a requirements, what does it bring you? So first of the things is that you have to have API infrastructure to be able to construct the flows of the APIs, to have different API versioning, to be able to provide authentication from the other systems. And then another thing, you want to have event-driven architecture. I was mentioning before that everything was in batch processes as on previous systems, but today you want to have a system that is able to recognize any event that happens and then make an action on that event. So it can be any business events, whatever does it mean, so for specific, let's say, level of the transaction for the particular customer or merchant. You want to have a system events if your memory usage goes up, if your hard disk is full. You want to have application events. Some of the applications are not working, some of the systems are not working, they're not responding, or they're delayed responses, or you have increased number of reversals. And you also want to have user events. Someone is trying to log in, not able to log in, or you have information on your customer that has mobile banking application and he's trying to change the limits, but something strange is happening, and any other operational events. So you want to have this as well. And then when you have a system, you want to be able to monitor. Whenever you have a system, you want to know what's happening. I mean, what are the infrastructure metrics? You do have a cloud, but you need to know what's the consumption of the cloud. Or you have any other, hardware over there, and you need to know what's the consumption of the memory, the hard disks, of everything. And then you need to have same things for the different components, which is database. Database is one of the most important ones. And then you want to use the new tools that are available for that one. And you want to integrate with different alert management systems so you get early notifications something's wrong. And last but not least, it's actually workflow and system integration. You want to have a tool where your business analyst is able to do the different workflows without the development, to have a drag and drop things, to orchestrate your business processes, to be able to have a small scale testing, test it, and then apply it to the entire environment. So based on all these requirements, and based on doing all this design on a blank sheet of paper, we came up with a solution that has these 8 characteristics, which is based on API, has a core foundation for all of the card products with the main characteristics, where the others are able to be personalized and customized and developed through the configuration. It's a cloud native, meaning that it can run on any cloud infrastructure, even if that's the public cloud like GCP, Azure, or AWS, or in the private cloud environment like OpenShift. It can have it can provide higher value for the quickly adding new value-added services. So you get easily incremental revenue on existing portfolio by introducing new services in a shorter period of time. Provide large number of the data to the external systems to get more information and ad hoc reports on the portfolio optimization. Enrich digital experience and personalization, meaning that each of the customers can, each of the cardholders can have ability to manage their own payment products based on their preferences. And then enable whoever operates the system to have a workflow with the microservices. And I'll have another pictures about the microservices, but just to explain why the microservices are very important. Just for example, you have a microservice to verify the PIN. And then, this microservice fails, so your system is not working for verifying the PIN. The new microservice for verifying the PIN starts up and continues working. So meaning that if something happens, the microservice that is faulted goes down, goes into junk, and another one starts in, and you don't have issues that the service will stop working properly. And as mentioned before, everything is happening in real time. You want to issue a card in real time? Yeah, you issue the request, you get immediately all the data that are necessary for you to issue the card. That's what enabled us to have a large number of the projects on instant issuing cards at the ATMs. You can drop by later on to see at NCR booth, we have one of the machines that are doing something like this. It's just a demo, not fully, but yeah. For the essence of time, I'll just go through some of the technical slides a bit faster. I have only 5 minutes, but these are the, let's say, key design enablers that we have used. But out of all these things, I would really mention 2 things. One of them is SDK that actually provides the customers flexibility to develop their own stuff around whatever is necessary without intervention from the vendor. And the workflow console that is actually helping the customers to orchestrate their business processes just by drag and drop. So this is pretty much a technical slide, but this is just describing the microservices, as I said before, which means that your system can be resilient as possible. Once when one of the microservices fails, the other one gets up and continues working. Multi-tenant architecture, pretty much, everything is separated, so users from one instance cannot access the data to the other. Everything is separated by the different APIs to the database clusters. This is the API orchestration, something I mentioned before, where you actually can orchestrate all the different APIs that you have, either it's IVR or mobile banking or branch or internet banking or ATM, into the single process like drag and drop, or we like to call it Lego bricks because you combine them as you want. And the workflow management. So it's code-free, increases the speed a lot. It is intuitive. You can simulate all the APIs before the integration, which allows you to do the quick and fast testing. You can easily, once you implemented something, code, copy and modify just a different kind of like interface, and build new services as business plugin, so you don't have to do the development. So these are some of the stacks that have been used, but the reason why I'm showing these is that these are the, let's say, buzzwords from the IT technology stack if you talk about modern technologies. And as you can see, all of them, or most of them are open source and available. And very important thing is that you can find a large number of developers that are supporting or are customized to work on these technologies. So all these things means that you can easily do card controls, issue the PIN over the SMS or to the mobile application, do the dynamic CVV quite quickly, the integration of these services quite a few seconds. Instant issue digital cards, either on ATM or on the wallet. So someone leaves your branch already has a card and waits for the plastic to be delivered in 2 days. Do the prepaid for the custom. You have this event, you do the prepaid card for the event in 2 days, or go with buy now, pay later, and orchestrate the flow and provide the different requirements, different propositions to the customer, even if it's the pre-purchase or post-purchase. More on journey. Hope you're going to get the presentation, so you will go on these two links and read more on how we did this journey with Google, and we put our platform on Google Cloud. If any questions, please.
Thank you, Daria. I would like to ask you, do you consider that open banking initiative will kill the cards or the card management system entirely?
Well, did cards kill the cash? So I believe that the choice of the payment is always going to be on the user. So whatever user decides, he's going to use the preference method of payment. So in some countries, you still have checks. And it's always going to be a mixture. And if you have noticed recently, card schemes are now trying to get into the open payments. They're buying the companies that are over there. So I believe that something will happen. And I believe, for example, if you go to the Google 3 years ago or 5 years ago, everyone was saying, oh, Google's going to go Google Pay, Google Card, and things like that. But what Google's going to do, they're going to go directly to the bank account. So next generation of Google Pay is going to be directly to the bank account. When I say card management system, I would say payment token management system, because for this system, it's totally irrelevant if you're using your IBAN, if you're using your mobile phone as a token or anything else. The principle is about accepting the transaction, being able to manage the flow, and do the communication with the external systems.
So do you consider that Apple and Google will go to the IBAN infrastructure? Because
well, I think Google already kind of like announced these plans.
I mean that instead of Apple Pay and Google Wallet, we actually will see the the wallet which will not use the card infrastructure, but it will use the account to account.
Yes, and I don't know if you know, but PayPal tried to do it like 10 years
already
ago?
for quite a while. Tink as well.
Yeah.
Why I was asking, because I have seen already the solutions. Then you pay by phone, and there is no card, and you pay through the POS terminal and using the phone. So that's why it's scary.
Yeah, there are a lot of solutions. I even saw a solution where you actually do the payment on the phone, on the POS terminal, using your microphone. So there are multiple. Any other questions? Opa. No?
Dario,
thank you for your time.
Let's have a round of applause for Dario.
Thank you.
And please take the stage as the moderator of the panel discussion. So next item on the agenda is a panel discussion on ESG transformation, moderated by Dario. So other panelists will be Elma Agic-Shabeta. Elma, please join us on the stage. So Elma is a Risk Control Division Director and Risk Board Member at Bosna Bank International, BBI. For the past 20 years, she has held various leading positions in the finance divisions and integration projects at BBI Bank in Sarajevo and HVB Bank Unicredit Group. In parallel, she performed the duties of Program Director of Sarajevo Business Forum. She has been engaged as an assistant professor at the Sarajevo School of Science and Technology. Welcome to the stage, Elma. Next panelist will be Rosvaldas Krušna. Rosvaldas, please join us, from advisor to the board member at the Bank of Lithuania. Rosvaldas is an economics and finance aficionado, currently working as an advisor to the board member of the Bank of Lithuania, with core responsibilities within financial market supervision, lover and a lifelong learner of sustainability application in financial services and products, working within the sustainable finance field both on national and EU levels since the regulatory inception. Welcome, Rosvaldas. Then Vladimir Davchev from Halk Bank Skopje, Head of Risk Management there. Vladimir is currently Head of Risk Management at Halk Bank Skopje. With more than 20 years of experience, he participated in multiple development projects for the implementation of an efficient risk management system in the area of credit risk, establishment of novel and digitized credit decision-making processes. At the same time, he's a member of the Risk Commission of the Macedonian Banking Association, a regular lecturer and coordinator of the Certified Risk Manager program at the Academy for Banking and IT Skopje, as well as an expert lecturer at the Faculty of Economics in Skopje. And Sebastian, who we met before, so no need for introduction, will be joining the panel as well. As you see, a very distinguished set of panelists. Dario, floor is yours.
Okay, thank you very much. So, thank you very much for the participating. In the preparation for this, we had kind of like a bit of discussion, so we kind of agreed what would be the interesting topics. And I'll maybe start with Sebastian far end. Hello, Sebastian. So, what does ESG transformation means for the banks, and what's driving it? I mean, what's your view on that one?
Thank you. Yes, you look indeed very far away. Well, I think expectation increasing for all business and of course for banks as well. And banks are very much aware that they also need to act on well, major societal issues such as, of course, climate change. By the way, it's also interesting to mention that given that 70% of the external financing of the EU comes from banks, it places the banks, of course, in a very important position on the contribution to the shift towards a more sustainable economy and society. Now, what it means for banks, it means also, of course, abandoning, I would say, the business as usual. They need, of course, to implement it through an holistic approach. They need to integrate environmental and social objective into the core business. It means also opportunities, because sustainability is more and more, of course, subject to differentiation and a competitive advantage if you stay ahead of the curve. And staying ahead of the curve is not as easy as that, because I think it's one of the fast-moving topic for the time being. Now, if you look at the main driver, I would say there are two types of driver. One are the external drivers, and just to name some of them, well, the peer pressure, international non-regulatory frameworks. There are a lot of collective actions like the Net Zero Banking Alliance, which push banks to act. You have the regulatory and supervisory pressure. I'm sure we'll come back to that as well. You have pressure from investors and external stakeholders. More and more, I think sustainability is becoming an important part of the decision-making process of bank clients and investors. And perhaps on the internal drivers, you have the risk considerations. I think banks themselves understand that climate and environmental risk have material impact on their risk profiles. And so they need to start developing, well, management and risk management tools to understand them better. And last but not least, I think it's of course also, well, business decision themselves, as I mentioned, competition, performance, also maintaining profitability in the long term. All those makes also sustainability as a very important driver of changes.
Thank you. And Elma, just going to you, how do you think all these changes are related to the banks in Southeastern Europe or Western Balkans? Because obviously these countries are not in the EU, but it is still related or correlated. So what's your view on that one?
Okay, so first I will present some results that were very interesting for me that came as a result of European Central Bank stress testing that took place, and the data were published just recently. So based on that stress testing, it was concluded that 60% of interest income is actually coming from non-financial corporates that are relying on greenhouse emissions. So this actually refers to 22 most relevant greenhouse emissions, and 60% of total corporate non-financial corporate income comes from these companies. So this gives us a very good sign of the importance of what is actually going to happen in the upcoming period. If we talk about Western Balkans, I will limit now to the Western Balkans as such, because Western Balkans is not part of the European Union yet. We have to say that all these countries, namely Albania, Bosnia and Herzegovina, North Macedonia, Montenegro, Serbia, they have committed themselves first to reduce carbon emissions by 30% compared to 1990. And in addition, they have committed themselves to go to completely net zero emissions by 2050. These are huge commitments. What we see in reality is that actually not a lot is done in order to implement these commitments. So it is true that most of the countries have brought relevant regulations that are needed in order to accelerate the decarbonization process. In Federation of Bosnia and Herzegovina, one very important regulation that is actually supposed to give push to prosumer sector and enable renewable energies to be implemented quicker has not been brought yet. So, and also in general, the level of renewable energies in all these markets is actually at the embryonic stage of development. Positive sides is that wind energy and solar energy in all these countries has actually great potentials. If we look at relevant studies, we may bring conclusion that all these countries have really huge potentials and higher than most of other European countries. And on the other hand, these potentials are not used. They are actually completely unused. So there is a huge gap between what needs to be done and what has been done so far. And acceleration has to happen very quick. We see now in the context of Ukrainian war and Russian war, we see how important energy independence is. So I'm afraid that renewable energies are still not really seen as a way to become energy independent, unfortunately. We do see increased interest from corporates and also from private entities, but the level of interest is still not enough. It's still seen more as something that is imposed from the West and so on.
Yeah, thank you. And Vladimir, going to you, and kind of like all these things are assumed that they are burden for the banks, but are there any benefits? And also having this gap where you have, certain demand, but there are no companies that are able to fit in all the services and requirements regarding to this. Do you see that this is also potentially an area to have some specialized companies that are doing specialized services for this type of the...
For sure. For sure, I think that we should try to foresee some developments from the data perspective in the local markets, predominantly related to the needs, data integration need for the assessment of the clients and the project itself, using some maybe foreign perspective. Because I will tell a short anecdote. When the first time I came with the ESG story, some of the bankers in the bank thought that we will need to employ machine engineering to be able to assess our clients, and there will be a bunch of it, and starting to think whether we will stay the bank or something else. But in fact, there's a very big opportunities. There are very good cases. For example, in Canada, they have tried to extend the credit assessment to a credit sort of a level like a credit bureau, they're starting to pre-assess the ESG concept to the companies. At least I'm not seeing that it will be a so automatic artificial intelligence rating model for ESG for a certain period of time. But as long as regulation does not push us, we will need to gather a lot of data to be able to assess. But that's only one layer. The other layer of information and how we can develop the competencies within the bank to be able not to make another silos of a credit assessment or whatever, but to embed the ESG approach of assessing particularly to specific sectors or subcategories of it in the risk management framework, but also not for the guys in risk management. The people in the bank should be aware what is the added value of it. And if we take into consideration what are the data and what we are receiving now, and we have now a couple of years of information from perspective what is the impact of implementation of ESG, we can say that it's very valuable for the banks. Either from our local perspective in Western Balkan, we can say at least we can use it as a risk mitigation technique. So we will, if some client has a better structured risk management or ESG approach, for sure, not just environmentally, socially, it will cover some of the aspects, and to the bank will for sure be some kind of a lower risk perspective from into the aspects of ESG implemented in certain company. But on the other side, I'm always saying the forward to basics. So try to as much as we could foster the implementations also from the social perspective, baby steps, and move it forward to be able to make a certain robust system. I'm not sure that we will stay at that pace because we are tackled by the regulatory aspects as a banks. But if we rely on some partnership, as I said, and construct some assessment from outsiders, a third party that can gather at least instantly some of the information that is required for the ESG is one of the ways that we can at least have some data background to be able to assess our economy. Currently, we are not ready for sure, and there will be a lot of burden on the banking sector all across our countries that will maybe be pressed by the regulators. But the benefits are here. For example, in the United States, the average companies, like price per earnings, are 12% higher for the banks that employed ESG frameworks in their banks. Also, 15 to 20%, the clients care, the awareness of the economy is on that level that are more eager to leave the bank if they are not employing the ESG strategies and they don't want to work with a bank that does not have that system. So on the other side, the economy could penalize us as a bank if we don't go to that path. But the benefits, and as a risk manager, I'm saying that we should take the benefits from assessment and risk management system in place to be able more wisely and more efficiently assess our clients and use it as a technique that will mitigate the risks.
Thank you. Okay, interesting, especially about this increase of the revenue of 12%. Russell, from your point of view, can you share with us what are the explicit and implicit costs of ESG transformation, and would it be some different discount rates for ESG as a part of potential solution in this transformation?
Sorry, could you repeat the last part?
Yeah. So would a possible different discount rates for the ESG securities be a part of the solution?
Yeah, probably. So let me tell you this. As the central bank, we speak with the suppliers in this sense, the banks, the demand part, which is businesses, societies, and we get different opinions and different opportunities from both sides. So who drives the ESG demand is a question, and it comes back to the SES law, whether it is supply that drives it or demand drives the supply? That's the open question. But obviously, what we get from the businesses is that they wish to do environmentally friendly activities because they see some essentially financial benefits to it. So for example, the allowances for emission tradings in price terms increased, like 5-fold in the last 4 years or so, 6-7 years. So the companies that pollute less now, every single marginal point of pollution is cheaper for them. So from the perspective of the bank, you obviously have a question. Do I credit or support the environmentally friendly company or that which is not? So obviously the companies that were not environmentally friendly because of the price of the allowances are experiencing disturbances now, which has a financial cost to it, obviously. But from the business perspective, what we often get, and actually I got, even last week, I was talking to a company that's making bread, and they told us, we wish to go the environmental way. We wish to get new equipment to pollute less, to be more socially responsible, but we need capital for it. And it's rather expensive in this environment with the interest rates. So what they're saying is that they wish to get cheaper capital if it's for the environmentally friendly activities. Obviously, as members of banks, you know that banks do offer green loans, green securities, but what businesses tell us that usually the interest rates are just the same or not even the higher. So I think that's the issue in terms of securities. On the bigger scale, obviously, if you go to large companies underwriting huge amounts of capital, the interest rates might be lower, especially in the European Union. We're going to have the green bond regulation. So if we will have those lower interest rates, the values or the valuations of the companies might increase as well due to the different discount rates. So those are the very explicit costs and direct costs, but there are many indirect costs of, well, sustainability in general, not just environmental part of it, but the social part of it. So just imagine you have a company with, I don't know, a 500 employees, and you have a rotation of 50%. So 50% of your employees just change every year. They do not like the place, they do not like the social environment in it. Well, it has both direct costs and indirect costs. You're obviously losing talent, but you're obviously spending money on the research of people, on the employment process. So those are the costs. You have more, let's say, indirect costs. So look into very simple interconnectedness between the ESG and finance. So a very simple example, let's say you have a farmer and you say you have a drought this year because the temperatures are rising. So the farmer is going to have less harvest. The farmer is going to get less money for his harvest. He's going to, or he might struggle to pay his loan. Then the bank might back those loans into different securities. And then you have this line from the environment to the further economy. And then you have further economical questions that I think are very important in this environment. So just for example, if you do quantitative easing by buying bonds, do you have less impact on inflation if you buy green bonds? And those are very real questions. Just for the very simple example I just gave you.
Yeah. Okay, thank you very much. You also tackled some of the social aspects, which were also very interesting to learn. Elma, from your point of view, how do you see creating a new market segments, and what are that are going to be a result of ESG transformation, like prosumers and others? How do you see this? Because I believe this opens a quite new space for totally new markets. Yeah.
Yes, ESG transformation brings big new opportunities in both corporate and retail market segment. For corporates, it's large wind projects, solar projects, and many companies are already getting involved in such projects. On the other hand, the topic of energy efficiency. All Western Balkan countries are spending more energy, several times more energy than the EU average. So energy efficiency is a field that is going to attract huge investments in future, and this is going to reduce energy needs. And it is going to either to reduce energy consumption or to increase the capability of the economies to export more energy. Because, for example, Albania, Montenegro, and Bosnia, and Serbia especially, they export significant amounts of energy to other countries. And most of this energy is actually based on fossil fuels currently. So, especially in energy services, in energy sector, there is going to be currently energy services companies that offer solutions for implementing energy efficiency. They are not implemented yet. They are in the process of development. And we know that these are the main drivers in the energy efficiency segment. On the other hand, when we talk about retail segment, a prosumer market, prosumers are those that actually at the same time produce the energy for themselves, but also are able to sell the energy to the electric grid and to sell the energy to the system. And currently, the regulation, as I said, exists in most countries, but this concept has not been developed. So the concept of citizen energy and energy communities is going to be developed in the upcoming period, and it's very important that banks take this process very seriously, that they take a proactive approach in developing new products that are going to satisfy customer needs. Currently, there are some European financial institutions that support and give subsidies for energy efficiency projects, but these are still very, very low amounts. So, and then finally, one very important segment of corporate new opportunities is actually in the area that actually refers to the regulatory framework. Carbon adjustment mechanism that is going to be introduced for the countries in Western Balkans at the beginning of 2026 is going to make obligatory a payment of compensations for all products that are exported to the European Union. And currently, there are several products that are defined there, and they are actually electricity, iron, aluminium, fertilizers. And all these companies will have to pay taxes on exporting their products. So that means that all these companies will have to change their business models, adapt their business models, and this risk has to be already taken into account when assessing such companies. So Vladimir already talked actually about this topic, where we actually definitely need a huge investments in education of bank employees. On the one hand, on the other hand, also developers. Developers are new in the market. They don't have real experience in implementing these small projects. So that's also one area where a huge risk exists. And finally, this whole new agenda, green agenda, makes this country, is actually going to make attractive all these countries to attract foreign investments. Serbia, for example, was the first non-EU member that already issued green bonds amounting to 1 billion in the European market, and the prices were quite good. So this is the area where that is interesting for investments on one side, and it can give push to the economic growth and macroeconomic development in these very, very volatile markets today.
Thank you. Yeah, no problem. I mean, this discussion is not just...
No, it's because efficiency is the magic word. All the economists love the word efficiency because that's the purpose of economics in general. But regarding the efficiency, there is a program of building refurbishment going on in Lithuania, which is going to be upscaled to Europe-wide most likely. Why I'm mentioning this in this public is because those old, well, I'll just say the word communist-style buildings are extremely inefficient, just insanely inefficient in terms of the heat capacity, the electricity conduction, etc. So the approach we came up with, well, not us, not me, but the country, is to do public-private partnership in terms of investments. So you get part of the governmental investment, but it's not too large, so you do not crowd out the banks and the basically, well, retail investors in the end of the game. So that's just a good model, I believe, and a good example of how investments and credit can be combined and with the governmental part and move into, well, the broader economy in general. So, yeah.
Okay. Yeah, that's actually a very interesting concept. We'll talk more about it.
Okay, and Sebastian, I mean, what actually the banks are doing to follow the ESG? I mean, asset transformation, but how it is, you know, done from the EU global regulatory environment, and what are the developments over there?
Well, if you look at what banks are doing, I think it's threefold. One is, of course, risk management, as it was mentioned, trying to embed climate risk into risk management. We recently surveyed 30 European banks, and really a very small percentage, and that's reassuring, of course, confirm that they did not yet start the process of embedding climate risk. Of course, this is not easy. Those are long-term risks that you need to embed into what is normally a more shorter horizon risk. And now, of course, banks are working with I mean, the ECB, with supervisors, regulators, to try to develop methodologies. And also, of course, data availability will be improving because there is still a very important data gap, especially on the clients of banks. No, risk management, I say disclosure. Banks are also very much disclosing based mostly on the recommendation of the TCFD, but as you know, also they will be mandatory, no obliged to report also on their exposure. And last but not least, of course, what banks do is also, well, try to commit themselves to reduce their own exposures, but also exposures, or at least that is reflected also in their lending and capital allocation from their clients. And what they are doing now is trying really to engage with their clients, mostly in the most priority sector, energy, transport, agriculture, try to understand their transition plans, their targets. Now, this is about financing, but it's also very much about advisory, of course. Now, if you look at the regulatory environment, actually, the regulatory environment try to answer those objectives of enhancing transparency. Second, trying indeed to ensure that risk stemming from climate change or other environmental and social issues are managed. And last but not least, try to reorient capital flows towards more sustainable investment. And so all those objectives are, of course, backed by, regulatory initiative. Well, just to mention some of them, well, you have, of course, as very much the underpin the EU taxonomy, which is, of course, very important, the classification tool of what economies, economic activities is considered sustainable. The taxonomy has started to define indeed what green activities, what are the green activities. Now very important is, of course, to mention that it's very good to know what is green, but it's even more important to understand how to go to the green. So it's not the green, perhaps the most important, but the greening. So the transition to more green, and that's why we also discuss very much with the institution on how to extend the taxonomy to better consider the transition. Quickly, I mentioned also, well, managing the financial risk, the regulatory initiative relates more to prudential treatment of ESG risk. So notably, and I mentioned that in my previous intervention, the capital requirements regulation, the capital requirements directive, how to make sure that those risks are indeed reflected into the risk management of banks, possibly through Pillar 2, I would say, increase capital. We are not yet at Pillar 1. There are discussions about that. Of course, we believe it's certainly premature. And then on the transparency, I could mention quickly of course, the non-financial reporting directive, which has now been transformed into a more ambitious corporate sustainability reporting directive. You have the sustainable finance disclosure regulation. You have also requirements for banks to disclose themselves their EU taxonomy alignment as of January 2024. Now, on this specific aspect, as I mentioned, the difficulties for banks already to disclose their level of exposure is, of course, that they still need to collect the data from their clients, and we are not yet fully there. We'll go there progressively, mandatory for SMEs, non-quoted or not listed SMEs, as you know. This will be more on a voluntary basis, but we hope that initiatives such as the one of EFRAG, so the standardization body which is defining the non-financial reporting standard, will help indeed companies to report on a more standardized way their exposure to ESG risk, which would then allow also banks to take them into account into their own disclosure, but also into their lending and allocation of capital policies.
Thank you. Just to be conscious of time, because we have a couple of minutes more before I ask for the final words from the participants. Any questions from the audience? One question, please.
ESG discussions mostly focus on opportunities and benefits, and not that much discussed about the risks. So what are biggest risks or threats do you see in this ESG transformation, if any?
You want someone particularly to answer, or?
To all of you.
Yeah.
Who wants to answer?
Well, we don't have time for 5 answers because I believe everyone has its own view. Who wants to pick up this one?
I think that the biggest risk is to transform and not to transform in a proper way, and in a matter of structure, and to embed the concept of ESG in the overall a risk management function in the bank. So if you make another silos, then you will have a specialist somewhere else in the credit function that are governed and will not understand and embed in the whole credit function. If you don't push to understand the opportunities and the benefits for the client and for the bank from the beginning until the end, even with the foreclosure process or NPL management in the whole process, especially in the sales, to persuade the clients. That's why Elmo was mentioning also, always educational part of the clients, it's very important. What are the benefits for them? Then you will have a failure for sure. And maybe you will have the assessment of the risks that are not proper even for the bank. So you will put something below the carpet and you will not see that maybe there is a major risk behind. I want also to mention one, we will always have to implement something new with, I always say, pull and push strategies. If we have a push from the regulators or from outside, we will need also a request for a pull for us. For example, pardon, a couple of months ago, the central bank decided to change the decision for obligatory reserve. So all the loans, exposures to ESG structured finances will be deducted from the deposits that are subject for the obligatory reserve. So it's another a certain pull element that the banks will be persuaded to be able to foster the implementation. But on the other side, we have cases for example, big structural project finances that cannot comply with the ESG. If we want to finance them with the consortium, we have a case when the consortium was 6 banks and 4 banks left the consortium because of the ESG rules, because there were 98 projects with this for around a big amount, a big ticket of loan exposure that cannot foresee that they will comply with the rules. And also there is the economy must cooperate as a whole from the central bank perspective, banks, but also the government to be able to converge. If in US we are talking about a risk premium that 65% of the population can add a certain percentage on the product if it has an ESG component inside, we have the opposite way. So the clients can run off the bank because they are implementing ESG rules, because they cannot foresee even no matter interest rates behind. So to use the convergence of the risk premium to persuade the clients that they, on the long run, because in Western Balkans we always see like everything a short-term solution, we are not seeing the long-term perspective, but we need to push also the economy and the government to make the subsidization or some incentives to be able all together push this forward in a faster manner. We have certain capacities and competence behind, but we were one of the major also failure issues that if we don't cooperate, for sure it will be some kind of a regulatory reporting compliance that will not have the impact to the economy as should be.
Thank you. So our slot is over, but if anyone has any questions, I mean, guys, we are on a networking conference, so approach to the participants over there and exchange information and ideas. Thank you very much for participation. I find this subject very interesting, and the answers I heard here for the first time, for some cases, I found them very useful. Thank you very much for your time and cooperation.
So thank you, Dario. Many thanks to our panelists. So just trying to summarize the morning in 5 seconds. So we talked about trends, all sorts of trends, geopolitical trends, macroeconomic trends, competition trends, ESG, you name it. A lot of stuff is happening around banks. This leads to need for transformation. And as we discussed, transformation is both technological, which is frequently focused on, but there is also a large need for organizational culture transformation. So much from me. I'll do my second attempt now to give the time of the break, hopefully this time punctually. So I wrote it down. So we are 13:40, we continue, not here, but in this secondary stages. So there are like 3 stages: lending, payments, and customer experience. So all of you know what is your interest, what is your stream. Thank you, and let's have a great lunch break and great rest of the day.